When the only constant is change, the only way forward is to jump in. And as the energy landscape transforms faster than ever, essential intelligence from S&P Global brings together critical data, price assessments, research, and insights so you can control where the winds of change take you. A better future awaits. It's yours for the seeking. S&P Global. Seek and prosper.
Hello. Welcome everyone to today's event, Climate Focused, Nature Positive, hosted by S&P Global Sustainable One. And thanks to Hub Culture for this great spot. Actually, the view from here, from this location, down to the sea, not right here, but when you look out, is one of the most beautiful I've ever seen. Like, what an amazing place Sharm is. I'm completely inspired by it. I'm Thomas Yeagle, Chief Operating Officer and Chief Product Officer for S&P Global Sustainable One, and it's my pleasure to give some brief opening remarks. I was reflecting that there's so many reasons to be here at COP and at this event today. We have a great opportunity to learn from an amazing slate of panelists and speakers. We have an opportunity to network with colleagues and clients and climate and nature experts and advocates from around the globe. We have an opportunity to plan for the future, how we make an impact, and how we work together to achieve our goals. This is only my second COP ever. Last year in Glasgow was my first. I'm so happy to be here. Following an historic COP26 in Glasgow, it has been quite a year of change and turmoil. Firstly, from a climate perspective, we had historic temperatures and heat wave in the UK over the summer. We had wildfires and more historic temperatures in the US and floods in Pakistan. From a geopolitical standpoint, the war in the Ukraine continued to thrust energy security into the spotlight and continues to show us that risks and opportunities are often systemic and conflicts can arise at any moment. Our S&P Global Commodity Insights colleagues have rightly pointed out the real trilemma we face between energy security, energy transition, and energy affordability. At the end of COP26 last year, only Scotland had pledged funds for loss and damage. But now, this year, this issue is in the spotlight with the EC president on Tuesday endorsing the idea of new funds for loss and damage. Scotland increasing its pledge, with Ireland, Germany, and Austria also making pledges this week. This conversation is front and center. And finally, biodiversity and nature are also a key theme of COP27. A pledge to conserve 30% of the nation's land and oceans by 2030 has gained support of 112 nations, up from 70 last year. An exciting time. I can't wait to hear more today from our fantastic speakers on these topics and on aligning the financial markets with net zero energy transition and exploring how we deliver on nature positive. Before we go into our agenda, I wanted to point out two things. One, the Wi-Fi, the Hub Pavilion, I might have it wrong, and the password is with, capital W, Hedera, capital H. And the second is we have a QR code on the screen over there to load our interactive application where you can respond to polls when prompted, ask questions, look at further resources, review the biographies of the speakers, and look at the agenda. With that, I'm going to hand it over to Richard Madison, President of S&P Global Sustainable One, for an exciting fireside chat with Rick LaKyle.
Thanks so much, Thomas. So it's a great pleasure to be here today in Sharm el-Sheikh. I first of all have to apologize. I actually realized I'm sitting up on stage and my son gave me these shark socks in honor of being in Sharm el-Sheikh. And the no tie, yeah, exactly. But it's great to be here today. We've got a really nice packed agenda for the afternoon. We're going to be talking about transition risk. We're going to be talking about the incorporation of nature in capital markets. We're going to be talking about aligning with net zero. And we finished the day talking to the chairman of the Egyptian Stock Exchange, which should be super interesting. But I'm really honored to sit next to Rick today on stage here. Rick is Executive Vice President and Global Head of Environmental, Social and Governance Initiatives at State Street. Rick was the CIO, Global Chief Investment Officer of State Street Global Advisors from 2008 to 2021. And so really has an amazing perspective on markets. I'm genuinely very honored to be sitting next to Rick today to talk about how markets can play a role in sustainability, in climate action, and a number of other topics. So Rick, State Street is one of the largest asset managers in the world, top 3, I guess, and also has visibility as part of the custodian services on over 40 trillion of assets under management. So I can't imagine any other organization that has such a unique perspective on what is going on in capital markets. I guess the first question I'd like to ask is, how much progress are capital market participants making on achieving climate goals?
Thank you, Richard. In fact, before I start, maybe I'll just acknowledge the partnership that we've had very successfully with S&P, particularly S&P Trucost and State Street. But S&P overall, we value that partnership very much. So how much progress has been made? I think financial markets obviously reflect the real economy to some extent. One of the things we've been doing actually at State Street is we look at the flow data. So if you look at the kind of generality of the custody data and you measure the degree to which institutional investors are decarbonising their portfolio, becoming less carbon intensive, there has been quite a clear trend. Now, part of that's that companies themselves are decarbonising. Part of it is a market capitalization effect, but it's also notable that people are rearranging portfolios. So I think people are taking account of the potential risk with high carbon intensity parts of their portfolio and taking action. But I think one thing is very important is that we need to be ambidextrous in this process, and by that I mean just as we need to be concerned about how we wind back the old energy system in a careful way, we need to wind up the new energy system. And if we get that balance wrong, we will have problems. And I think that's not really been done before, and we need to think carefully about how capital markets can simultaneously capitalize what needs to be in existence, and this is the $3 to $5 trillion a year in the next several decades, and at the same time winding back those things that are kind of legacy energy assets. And maybe we'll get on to talking about some of the most acute ones, but South Africa might be an interesting case in point that again has been discussed at COP27. So I think there's been progress, but people may say it's glacial, but it's certainly measurable.
So we need ambidextrous capital markets.
I think we need an ambidextrous approach to net zero. And I think things have moved along. When I think about how clients reacted in different parts of the world, 5 or 6 years ago, divestment was a strong motivator, particularly in Europe. I think it is still a motivator for a lot of people, but I think things have moved on in a sort of nuanced way, asking more pointed questions about a corporation's pathway and whether they might actually be an enabler of the transition, even though they might be a high-emitting business. So I think people have recognised the true complexity of the high-emitting sector and also recognised that we need to build up, with a sense of urgency, the new energy system and the hard-to-abate industries.
Some people have said, and I'll quote a very senior advisor to a central bank, who will remain nameless, but somebody said this today to me. Some people have said, we need 2 things only. We need to stop financing new coal, and we need to preserve and restore forests. The rest is arranging deck chairs, quote unquote. What do you think about that? What do you think we need to do to accelerate the transition to a net zero future?
Well, first, I'd agree that coal is a disproportionate problem. It's twice as energy inefficient from a carbon percentage as gas. And I guess that's why the EU taxonomy in the end was minded to include gas if it got us off coal. So I'm not sure I agree with any blanket statements, we should never do X or never do Y, because clearly it depends what else you do. It depends, turning off all coal investment sounds quite attractive, but the context is pretty important. But I would agree, coal is disproportionately damaging, and therefore one has to approach it with a sense of urgency. And I think equally, reforestation or nature-based solutions are very important. But I think if we don't get the investment in green hydrogen, other sorts of renewables, transportation, then we won't have achieved much, because shutting down coal, particularly in emerging countries, causes economic and social distress unless you actually have something else in mind. A great soundbite. I mean, I love soundbites in some respects, but you need to be, dare I say it, responsible.
It's the kind of thing that someone's just, someone says when they've just exited the Bank of England, I think. So you've been the CIO through the global financial crisis and cycles since then, and I just am really intrigued as to, you know, having had a really unique perspective on markets, what is your view of the future risks that we face as we think about transition, as we think about resilience and adaptation? What is your view of the future risks that we face and how to deal with them?
Yeah, so I think firstly that we should not underestimate the physical risk. Hard to get your fingers on, but I think there was a period where it was a little bit neglected because it wasn't, in a sense, a good thing to acknowledge the fact that the temperature might actually rise. In other words, we might fail in the endeavour to get to 1.5 degrees, and therefore, you know, we may go way beyond that. It was almost, you didn't want to acknowledge that possibility, and therefore there wasn't enough attention paid to the physical effects as opposed to the transition effects. I think that's changing a little bit, and I think, you know, people are producing more data on the physical effects, which is very welcome. But the physical effects aren't just about buildings becoming less valuable. That's obviously to do with the agricultural system, population movements, and those are quite slow-moving risks. The financial system is, in some respects, optimized for stress risks that crop up quite quickly. And I guess Mark Carney may make the argument that even a long-run risk suddenly crystallizes in the minds of the financial markets. That's true, but if you look at the way that a lot of central banks approach stress tests, they look at the effect on balance sheets or earnings on a reasonably short-term time horizon, 4 or 8 or 9 quarters in the balance sheet. And so it's quite difficult to demonstrate definitively that you've got that short-term risk with some of these really slow-moving ones. So we need to have a way of dealing with them through scenario analysis or some other mechanism to make sure that they're front and center for people. And I think there are also macro risks, which we can discuss, but I think the energy transition and the transition of the economy to low carbon will give rise to unexpected effects. And I don't just mean inflation, but that could be one of them. So I think we need to get ready for that, and I don't think financial markets are really good at doing that because we haven't really seen it before. You can't run the test backwards and say, well, you know, we've had one of these before, what do they look like? Because we haven't done it before.
So do you think our kind of long-run risk models need to change radically from being based on a 30-year history to a different approach?
Well, some things are universally true. I mean, if you go back to the 19th century, for example, there was an enormous build-out of infrastructure around the world, financed by private capital primarily. You had a lot of changes in technology, canals, railways, etc., electrification, and a lot of capital got exported from developed economies to emerging. So we've kind of done that before. But if you look back at capital markets and economies in the 19th century, they went through long periods of deflation in some cases, accompanied by strong growth. So that's an interesting combo we haven't really seen before. They also had huge booms and busts. I mean, in stock markets, you had massive, you know, railway mania followed by collapses. So as you move from one system to another, markets can be prone to that very extreme behavior, and we should be ready for that in relation to this energy transition. Now we need to have it, so we do need to attract capital into those markets, but it does look something like the 19th century build out of infrastructure and industrialization, but in a more deliberate fashion. I mean, that was much more organic than what we're seeing now, which is a little bit more top-down and particularly influenced by government policy.
So sort of more like a, like rather than an industrial revolution, a more controlled, evolved industrial
Well, I think
evolution.
we'd like to control it, but I mean, people have their own views on the subject, but state-managed capitalism can have problems, and it's been tried many times. It's not easy to pull it off. So if you're trying to wind down one energy system and wind up another, that sounds like you need a degree of kind of incentives and top-down control. It sounds like a great idea, but it's not an easy thing to pull off. And if you wind up the new one too fast, the effect will be you'll have too much supply of new stuff that will be unprofitable. Then you'll get a dearth of investment. So you'll have this kind of boom-bust cycle. Equally, if you wind down the old energy system too fast, we'll have another set of problems. So I do think it's a very, very delicate balance. And if you look at what happened in previous centuries, again, I don't want to be a history nerd, you know, in my country, we had canals from, I guess, the late 18th century. And that was a kind of big capex, big revolution, improved transport. And then, hey presto, you had railways, and the canal companies went bust. And in fact, you see in England a lot of places where the canal is alongside the railway. So we've seen this kind of thing before, and it was organic last time. Can we make it work this time?
So you heard it here first. We need a more considered approach to industrial revolution this time around, and a cautious one. Well, thank you so much, Rick. That was absolutely amazing. I really loved your comments, and looking forward to the rest of the session today. Thank you so much.
Thank you.
Thank you. Hello. Good morning. Good afternoon. My name is Sonia Kim. I'm the Global Head of Product for Sustainable One. I'm going to be emceeing the rest of today's session. Thank you again, Richard and Rick, for your insights and talking about the short-term and long-term views that we must have when assessing physical risk. So for the next section, we're going to be joined by Susan Gray and Jeremy Lawson. I'm going to let you introduce yourselves, and they're going to be discussing how you apply rigorous analysis to investing through the transition. Come on up.
Well, Jeremy, it's really a delight to be able to speak with you today. I'm very happy to introduce Jeremy Lawson, who's the Chief Economist at Aberdeen. My name's Susan Gray. I lead ESG and Sustainable Finance at S&P Global Ratings. And Jeremy was recommended to me by a colleague who actually said, well, I was sitting at a conference on my phone. Jeremy came on and started talking, and I put my phone down, and it stayed down. So that, Jeremy doesn't really like this because he thinks that's going to overhype this whole conversation. But but welcome, and it's great to have a fellow Australian expatriate on the stage as well. So Jeremy, Rick's comments were a great segue into this conversation because what we're going to talk about today is how, as an investor and as a portfolio manager, Aberdeen really thinks about transition and the work that you've done and taking into account the evolving nature of transition and the impact it's going to have on valuation. So maybe just to start off, could you maybe just talk about, in terms of the analysis that you did that guides the work that your investing teams are doing, what was your objective at the beginning of this exercise?
Okay, so I'll try and make this as intuitive as possible. So imagine you can see a chart that shows different temperature pathways over the next 30 years and then to the end of the century. And a lot of you will be familiar with climate scenario analysis, I'm sure. You'll sort of seen all the, the reference scenarios, like the NGFS scenarios that exist. And so what you'll know immediately then is that the scenarios that you have to work with, on the one hand, there'll be hothouse scenarios at one end of the extreme, which are largely physical risk scenarios. And then you have transition scenarios on the other side, where even the slowest, or even the transition scenario with the highest end century temperature, which is delayed transition, is itself a 1.6 degree scenario by the end of the century. So your reference scenarios, the things you have to work with, on the one hand it's 3 degrees and above, right? Or it's 1.6 down to 1.4 by the end of the century, right? But anybody who's investing around the energy transition should be able to spot the immediate problem, which is that neither of those outcomes are in any way likely, given the pathway we are probabilistically on. Right? So there is an energy transition taking place. We had sort of a good discussion about that earlier. It's undoubtedly the case that there's been an increase in the rate of capital spending that sort of relates to reducing the carbon intensity of the global economy. But it is absolutely not occurring at the speed that is required to be consistent with any of those reference scenarios. But equally, it is much faster than would be implied under a hothouse world. And so what we saw immediately was, if I'm going to go and speak to one of my investment colleagues and say, hey, you need to start to invest around the energy transition, and hey, I've got this model that's going to tell you what financial exposures will look like, but actually it's either a 1.6, 1.45, 1.4 world or a 3 degree world, they're going to immediately say, well, that's not very useful to me at all. Because asset prices will align with pathways that are, well, they'll align with the real pathway we're on, not some fictitious scenario. And so what we've done is we've built bespoke scenarios that try and fill in those gaps between those two extremes. Reference scenarios, one of their common features, particularly the NGFS scenarios, you back out a global carbon price out of a reference scenario, right? It'll say, okay, in order to be net zero 2050, and if we're working with one of the particular energy systems models, what carbon price is required to be consistent with that pathway. But again, we should all know the carbon price in Indonesia, China, the United States, the Eurozone, these are not the same thing. The power sector, transportation sector, buildings, these are not the same thing. And so if you're working with models, right, that clearly, there's this phrase in economics, junk in, junk out, right, is you're going to generate some really misleading results if you use them. And so we effectively divide the world into regions and sectors, and we allow for policy pathways to differ according to what we sort of see as more credible alignment pathways, so that we can generate much more realistic scenarios. And then because they're more realistic and they're benchmarked against what's priced into assets, we feel like we can have just much more sophisticated conversations about what the nature of the exposures are, and how that varies depending on what the future looks like.
Great, and so, because what you're really trying to do here is, and we've been spending a huge amount of time at S&P Global focusing on this as well, is to really sort of think about a company and what world is it in from a scenario perspective, from a sector's perspective, from a pathway perspective, what are the available technologies, et cetera, and how well is it doing, and how does that impact its value in the future. And this almost goes to the point that Rick was getting at, which is, you know, the short term versus the medium term and the long term, and how you effectively price that in. So maybe can you just step us through how you would be looking at this in, you know, like how are you thinking about the sectors, how are you thinking about the regions, maybe take a utility in America and an airline somewhere else in the world, given they do have different pathways, radically different pathways and different environments that they're going to be in.
Exactly. So what we can probably do is we can compare two fictitious companies operating in the same sector in different regions, and then also compare two companies in the same region but different sectors. And I think this will sort of highlight what this type of analysis can yield. So my favourite example is, imagine you have an Indonesian utility and you've got a European utility, and you're trying to work out not just what's priced into that asset for the energy transition, but how it's likely to evolve. Well, it's very clear that policy in the Eurozone or in the European Union directed towards the power sector is much more aggressive than it is in Indonesia. You've got an emissions trading scheme, which we think still needs to scale up to be truly sort of net zero compliant, but still you've got a carbon pricing regime that is in place. You've got other regulatory settings that are enforcing a fairly significant rate of decarbonisation of that sector. And because it's an emissions trading scheme and the budget is set, you have some certainty about what that emissions envelope is. In Indonesia, there's much more uncertainty about policy in the future. The carbon price, even if there's no official carbon pricing, the implicit carbon price is going to be a lot lower. And so clearly that utility is going to transition more slowly. And the way that you value a fossil fuel intensive utility is going to be very different than a renewable intensive utility in both of those locations. And so in fact, again, sort of imagine, I'm going to ask you to have a sort of a mental image in your head. Imagine every company in the MSCI Global Index on a scatter plot.
S&P 500, please.
Sorry, okay. What's your global benchmark? Imagine the global benchmark. Okay, sorry. So imagine your global benchmark, the thousands of firms that are in it, okay, and divided into sectors. So you can say the global utility sector, on average in our analysis, actually receives a boost from the energy transition that we're expecting, equivalent to a valuation of effective around 10% of its current value, which is not nothing, but it's moderate. But then I want you to think of this as a scatter plot with every utility in the world sort of lined up. And what you find is that some suffer enormous negative impairment, some in really large positive uplifts, but where the regional distribution is also uneven because a lot of the ones that receive the largest uplifts are in the advanced economies, and a lot of the ones that receive the renewables that receive the large uplifts are in there, and the ones that receive the largest downgrades are advanced utilities. But in a lot of emerging economies, because the transition is slower, you don't get either the same benefits or costs, and you have to be able to analyse that, because otherwise you'll get that investment wrong. Or at least if you're making a decision as a firm that you want to be on a particular decarbonisation pathway, so let's say that you've set a net zero 2050 goal, conditional or otherwise, you at the very least need to understand what the financial consequences of that commitment are going to be. And when I look around our industry, I see far too many institutions setting objectives that they haven't analysed properly, right? And that because we're definitely not on that net zero pathway, we're much more likely to be 2.2, 2.3, 2.4 degrees. That wedge is just going to grow over time. Right? And so that will create also then a wedge between the fiduciary responsibilities and these climate commitments. And it has to be taken really seriously.
And when you think about, I've only got a couple of minutes, so just quickly kind of summing up here, thinking about credit versus equity and thinking about new technologies, so hydrogen, sustainable aviation fuels. How can you just quickly take us through, how do you think about both of those elements, credit versus equity, and then how do you think about new technologies and as they evolve, as they become more commercially viable?
Yep. So, I mean, first of all, credit exposures are generally a lot lower than equity exposures. They're higher up the capital structure. An equity you can think of as a perpetual duration asset, whereas a lot of the credit the firms sort of will issue will be on a 5-10 year horizon. So you have to take that into account because the way that you then discount those future flows and what they mean for credit impairment can be very different. Similarly, the sector composition in credit is often very different than equities, so that's an important consideration. And then thirdly, your upside in credit is limited because, say, once the implied default rate reaches a certain trough, you can't benefit anymore. Whereas, sorry, is that you're not hearing very well?
No, I've got just so captivating. I have to ask a question. Sorry.
We can talk afterwards if you like. I know this is a bit of a whirlwind sort of tour through these issues. But anyway, some of the upside. Some of the upside in credit is also capped in relative to what you can get in equity, so you have to think about that quite different. In terms of your other question, which is around technology pathways, wasn't it? So I'll quickly sort of wrap up on this. Here, I think where you have to be careful is about differentiating between technologies that have already been demonstrated at scale, right, and technologies that are still speculative and nascent. Scenario analysis is not good at taking account of speculative technologies. They're not built into the energy systems models in the appropriate way. But equally, you have to be careful about buying your own narrative about what that future technology pathway is going to look like, because that's an incredibly difficult thing to forecast.
Yeah, and that's sort of the point, isn't it? Because
incorporate that into your work.
And then one final, very quick one. Government policy, consumer sentiment, they are also influences in your analysis that you talk about in your paper.
Yeah, I mean, politics, public policy incentives, these are, I mean, I take the point, for example, in the previous sort of conversation about, say, earlier industrial revolutions, but even those market environments, the concessions that were given to land, they relied ultimately on some degree of public-private partnership. Climate change is a market failure. It cannot be addressed without that market failure being addressed and without the incentive structure that force polluting companies to internalise the impact of their actions. Unfortunately, the politics is not consistent with the speed in which it needs to occur. So like that nuance, sometimes I think of net zero as I'll be very careful about words. So I'm going to say it's a red herring, not because I don't think it's desirable, but because it so dominates the conversations, it sort of squeezes out a more realistic and sophisticated conversation about what's likely to happen in the future and what does that mean for asset prices, which is still very interesting, but not the same as a net zero 2050 world.
Well, that's a great point to end on. Thank you so much, Jeremy. Really appreciate your comments today.
Great. Thank you, Susan and Jeremy. Thank you so much for those insights on reference scenarios in pathway analysis and the need to look at region and sector differences. We have a short intermission. We're going to try to shorten it just to get back on track on timing. So we'll take a break until 2 o'clock. So please feel free to get water, walk around, stretch your legs. One reminder before you all jump up, if you haven't done so, please make sure you're connected to the Wi-Fi. We actually have a different Wi-Fi for inside than we do outside. And the Wi-Fi information is posted up on that wall right there next to the sconce. And please make sure you do that so that you can participate in our poll, which we'll need the QR code for. Thank you.
Which one? Okay, so, yeah. And I sit here?
Is this for what? For photos? We don't want to mess with that. Is it for photos? No, that's the way the introduction is on the screen. I guess from this side. All right, let's get started. So the next session is going to be a panel, and I'm actually opening up for myself. Is everyone sitting down? I still see some stragglers outside. Okay, let's get started. We're going to be talking about the global economies and how they're dependent on nature and how it's becoming at the forefront as we think about climate risk. As companies, investors, and financing become more sophisticated in the climate journey, there's an increasing need for credible data and tools to translate information into insightful, into decision-useful insights. And while we need to accelerate that pace to get on the right path to adaptation and energy transition, the considerations are complex and challenging. We've been talking about emissions for some time, but increasingly the concerns tied to biodiversity and nature are coming to the forefront. Biodiversity and nature have been severely impacted by the effects of industrial development, existing and new. We know nature is a dependency for many sectors, so systemic risk to economies are a real threat. Then there's the interconnectedness of climate and nature. Renewable energy doesn't come without its trade-offs. The commodities we rely on for renewables, the power plants needed for clean energy, all impact nature. Assessing nature risk is critical and as part of the equation. We need to understand company operations, and often we can start by looking at assets. How do we manage those trade-offs between energy transition and the cost to nature? How do we use data to get insights and help us inform our path forward? I'm thrilled today to be joined by 3 business leaders. All of them are helping their own clients grapple with these issues. So let's hear about data and analysis that you're doing to help your clients and how they can use their data to drive capital to the right places to help us inform our plans. I'll ask each panelist to introduce yourself, and maybe you can start with why you're here at COP this year. Starting with you.
Great. Hi, everybody. My name is Raphael Valle. I come from Aon. We're one of the world's largest. Is this working? Yeah. We're one of the world's largest insurance brokers and risk advisory businesses. And I've recently joined the business, coming from banking and government and climate, because Aon just created a new central climate team to bring together all the different pieces of climate-related analysis and advisory that we offer across the business, so we can offer slightly more integrated solutions for our clients. And I'm the head of solutions and innovation, so I work directly with clients. And it turns out that in the insurance space, who's a little behind on climate if you compare to financial institutions, we have a lot of work to do in developing new products and new solutions with clients, but also with the insurance industry. And the reason I'm here is I think I'm finding it's essentially when you open the window in a room to get some fresh air is how I'm feeling about COPs, is that throughout the rest of the year I tend to talk to my clients and my stakeholders, and I get the same ideas, and I end up thinking that I'm the most brilliant idea generator in the room. But actually hearing completely different perspectives, meeting people I've never met out of my office is really what I need to make sure that I constantly challenge my perspective on this, and it's already been a brilliant experience for that.
Great, thank you.
Good afternoon, everyone. My name is Ilya Heiken. I'm a partner with Oliver Wyman as a management consultancy. So my work is on issues of climate risk management, net zero, and climate strategy. I'm here at COP primarily, I would say, to learn how to better serve clients, to better serve my clients on the topic, to understand a lot of the debates that are going on, and in very much the same way so far, a lot of the experiences that I've had, the most valuable ones have been ad hoc interactions with people that I otherwise would not be talking to, that really sort of pushed what I understood and pushed the boundaries.
Hi, good afternoon, everyone. My name is Prerna Devecha, and I lead the business for credit and risk solutions within the ESG segment at S&P Global Market Intelligence. One of the things that we're doing is, as we see more of the integration of climate and ESG into credit risk, we're at the front and center of developing offerings that speak to how climate affects each and every facet of credit risk and of course more broadly financial risk as well. The reason why we're here at COP, of course, as part of S&P Global, and of course in collaboration with Sustainable One, we're in the space of constantly innovating within the ESG space and offering world-class sustainability-linked solutions to our clients, and we have 700 plus billion data points on ESG, and we want to be able to share that with our clients, with our stakeholders. So obviously, that's one really good reason for us to be here, right? And secondly, as my fellow panelists said, we also want to be here listening to how our clients are facing these risks, how they are thinking about various approaches to climate risk. And we're in this with them. This is a journey, and we're obviously looking to learn from that experience and build on it as we look to further develop our solutions.
Thank you. Welcome.
Yeah, thank you.
Well, let's get cracking. So my first question for you is, what is driving the demand for climate data? Why is asset level data so important to companies and investors? And you're all solutions providers, so it'd be great to hear from you. We'll start here with you.
Yeah, sure. Well, I think all sorts of things are driving demand for climate data. And in Europe and the US, regulators would come first. There's a lot more pressure on businesses, quite rightly, to disclose more transparently on what it is they're doing. And not everybody has that data, so that's driving demand. Better managing risks is another one. And to your point about asset level data, the reason that's so needed, I'll give you the example of one of our clients who is a very large manufacturer of white goods. The issues they're having around climate risks are totally different depending on which manufacturing plant we're talking about. So they have a huge production facilities in South Africa that haven't ran for a very long time because of drought, and so they can't access the water they need to cool the operations. And similarly, they have a huge manufacturing plant in Pakistan that also hasn't been running because of flooding. It's a totally different issue. And so if they didn't think about this at the asset level, they just couldn't understand how individual bits of their business would be affected, and therefore how they need to think about resilience and investments totally differently depending on where they are. And I think it's also data about reducing the cost of the transition. We've established it needs to happen much faster, but for a lot of businesses, that's more of a cost than it is a business opportunity. And so having the data over how do your physical assets all around the world are actually working today? What are smart investments? What are not so smart investments? What works the best? Where should you be offsetting and how? We can't answer these questions without data. So
absolutely. Thank you. Ilya, in your business?
Yeah. No, I think it's, I see a very sort of similar trend. I think about it in from two directions. One is understanding the risks, and we need the data to be able to do that well. The other is on the net zero side. Most of my clients are financial institutions. Many of them are setting up strategies around net zero targets, sectoral targets, and how are they going to get there. This data is critical for both of those exercises, and of course, the angle that it comes from, I think many institutions were starting to work on it initially, but now the regulators pushing both from the perspective of the disclosure standards. We saw in the US, the SEC proposed rule that came out, disclosure standards in Europe, and of course TCFD and others. And then on the prudential regulation side for financial institutions, of course there was in the UK the climate scenario analysis, the CBIS exercise that was done, the ECB in Singapore and other jurisdictions, and now they've announced in the US that there'll be one next year as well. So those are the big drivers. In terms of the sort of asset level question, I guess in summary, I think back to what Jeremy said in the last discussion, right? And that utilities, the impact of the transition on a utility, it's going to be very different for one utility versus the other, depending on their profile, one country versus the other. There's no way to really do that, to understand that well, unless you have that asset level data. The same for physical risk, right? We need to know if the house is on the top of the hill or the bottom of the hill to understand its risk of flooding. So asset level data becomes critical there.
Thanks, Ilya. Prana.
Yeah, sure.
Talk a little about what your clients are needing and how you're helping solve those problems.
Yeah, absolutely. I think there are three sort of drivers, and they're kind of interconnected in terms of why this data is important and how important it is. Number one is the evolution of use cases, and we're seeing that, from what data was required for 10 years back as data for investment allocation, exclusionary screening, more that was, for the capital markets at that point in time to, as I was saying earlier, the integration of climate data into credit risk management, into policies, into strategies and governance, as Ilya was mentioning as well. And so that evolution of use cases has been one key reason for the importance of that data. And number two, of course, is the recognition from regulators, policymakers, and politicians on the need for addressing climate risk. We're seeing that from banking regulators and supervisors. We're seeing that through the NGFS, contributing to the awareness of climate risk and integration of that in risk management frameworks. We're seeing that from the TCFD and now also the TNFD. And so that's really I would say a second reason and interconnected to my first point, right? And then thirdly, I'd say there's also that increasing sort of self-awareness and recognition of the fact from companies that climate risk is a driver of business value or a disruptor of business value, that recognition is also coming from companies and markets where perhaps regulations don't exist. So these companies are making efforts, even without any sort of regulatory pressure, and that is because we've seen studies and research and which sort of alludes to the fact that a third of the largest companies in the world have about 20% of their assets exposed to physical risk, and so linking that to the assets and the ownership of that assets at the company level is going to be important, because that would then either contribute to the business value or disrupt that business value, and so I think these are perhaps the key reasons, I'd say, for the importance of climate data and the importance of granular asset level data as well.
Excellent, thank you. So you heard how an insurer is thinking about their business and how their clients need to factor in asset level data into their analysis. And we also heard about the reporting use case as well as the need to integrate this data into the credit analysis process. Maybe we can shift a little bit more to how are you actually assessing exposure and financial impacts using climate data? How are you doing that to make it decision useful? Maybe we'll start with Ilya. We'll start with you.
Sure. So a lot of our work is on topics like climate scenario analysis, and that's become a key tool to assess the impact of climate on financial institution exposures. So we started working on this actually it was around 2017 when the TCFD recommendations came out. We worked with the United Nations Environment Program to develop a methodology for climate scenario analysis of financial portfolios focused on transition risk at the time. And one of the things we quickly realized is that the traditional approaches for doing scenario analysis in the banking space are not going to work for this, right? Because we don't, ultimately we need to figure out how climate impacts credit risk, as Prerna was saying, for example, as well as other categories, but take that credit example. We don't have a history of that, right? We can't, the same way that we understand how GDP impacts losses in the financial sector, we don't have that same data for climate. So the way to do it is through a much more bottom-up, fundamentals-driven analysis. To work through, for a given company, okay, if there's a carbon tax if the energy mix in the economy changes in this way, if electricity prices do this, what is that going to mean for the profitability of the company? What's that going to mean for the balance sheet of the company, its equity position, and thereby, what is the implication on the financial risk associated with a loan to that company or an equity investment to that company? So a lot of our work has been on developing jointly with S&P our product Climate Credit Analytics, which does this, right? Which basically looks sector by sector, company by company, how can we tie climate change to the drivers of business performance? And in other sectors, outside of corporates as well, there's similar types of work that needs to happen on real estate, on commercial real estate, mortgages, et cetera, doing that kind of granular bottom-up analysis to map out how the climate drivers impact the drivers of performance of these asset classes.
Thanks, Elia. What about you?
Yeah, well, you've covered transition risk so brilliantly. I'll talk a bit about physical risk. And I think this is such an interesting point of evolution for the insurance sector, because we've looked at climate risk for 300 years in insurance. I think the first detailed models around cat risk came in around the 1980s. But we can no longer rely on the way we thought about climate risk so far, because the models that insurance has built in climate risk and elsewhere are all backwards looking. So we're thinking, right, this is what we know about the past, therefore the future is going to be some version of that. And obviously that doesn't work in climate. It is such a dynamic, fast evolving space. So we're having to invest a lot in transforming our approach so that it is much more forward looking and much more about forecasting, etc. So that's kind of the first step. And Aon, I think, invest something like $200 million a year in talent, in tools, in data, and partnering with others so that we understand that a lot better and we can help our clients understand that a lot better. The bit that's really hard is translating that kind of scientific understanding of climate risk into dollar numbers, right? So clients still don't quite, or still find it difficult to understand how a storm event or a hail event or a flood translates into financial loss on the ground for their business or business interruption, etc. And we're really having to match these sophisticated questions with clients. And so we've partnered with S&P and your climate service business line to help do that, to turn the climate science into dollar signs. And that's been a really powerful tool for us and for our clients in understanding that. And then we're taking that, again, to the next level by using all of that information to, again, on an asset-by-asset level, advise clients on how they should be investing in resilience. So what level of investment gets you what resilience measures, and therefore how that might reduce the losses that you might suffer in any kind of climate event. And that's the really kind of powerful combination of all this. But it's requiring really fast evolution to match demands from clients. It's been a really interesting space.
Great, thank you so much for that. Prana, do you have anything to add to that? We talked about the importance of, well, what I'm going to let you add. I'm not going to regurgitate.
Well, I know, there's not much left for me to say, right? We've covered transition, we've covered physical.
I was going to say, our panelists covered so much. Really insightful, thank you.
Yeah, no, absolutely. Well, I think I'll just extend that a little bit and say that, we then need to think about, all of these as different types of measurable hazard models, which, when you look at some of the work from the climate service, right, it's been about taking these different hazards and then overlaying these hazards on different asset types. And I think that piece is quite important, and getting into specifics of that is quite important, because different hazards would affect different assets in different ways. And so if you think about a hazard like water stress, how that affects an asset such as a paper mill would be quite different to how that affects a wind turbine, because water is core to the business operations of a paper mill. So it's not only about water expenses, it's also about interruption of operations. And so, the financial impact is a lot more to that asset. And then if you think about that for a wind turbine, it's going to be less significant. So that granularity is required to be able to put a pin onto the financial risk. And then you do that at the asset level. And then in order to sort of roll that up to the counterparty or the company level, you require, very good sort of mapping and data on asset ownership, on linking that asset with various owners of these assets across the globe, and how they would then sort of react to this in terms of all facets of the financial statement, right? So then building out future projections of financial statements under various scenarios, feeding that into models, whether these are credit models or equity valuation models, and and that sort of work would then help you, put a sort of quantitative impact on credit scores or valuations. So I think that sort of extension is what we're currently looking at in terms of integrating physical risk into some of our models. And then the other piece is, there's that connection between, or rather reverse or inverse relationship between physical risk and transition risk, right? So you can do this analysis in isolation, but then there's also a bit of that overlap that you need to consider when you think about integrating this and creating models that speak to both physical and transition risk. So that's, again, some of the work in the space that we're currently focused on.
Great, thank you so much. So we heard the importance of a forward-looking view, bottoms up, asset level data enables us to do that. And Prerna talked about really understanding the different types of assets that you're exposed to and how that can really change the outputs of your models, of your scenarios. I'd love to shift now away from physical risk, but to a very related cousin topic, which is biodiversity. How are companies and investors, your clients, starting to look at nature risk? Let's start with you, Prerna.
Oh, okay. Sure.
Trying to change up the order here.
Yeah, I get to speak first now. Well, I think, again, we're reading off some research and statistics that are recently published. The dependency on nature is actually a very sort of large number, and I read it was $44 trillion in terms of, or half the GDP of the world, that is dependent on nature. So there is that obvious need for companies and investors to now start looking at nature as well as part of their overall sort of climate risk and environmental risk analysis. But of course, nature is incredibly complex. One is really still looking for standardized measurements and metrics around nature risk. So it is an evolving space, and of course, we're seeing the beta 3 version of TNFD that has been recently released, and we're also seeing a number of sign-ups to the TNFD. I think from just a year ago, there were only 200 members to what we have now is 600 members, and S&P is part of that, membership of TNFD, and so yeah, there is growing recognition of nature being part of financial risk, but of course there are a lot of challenges. Again, we speak of things like overlap. So nature and transition and physical risk and the overlap, and people are obviously aware of that overlap and perhaps want to be cautious of double counting that risk, and hence why the more sort of clarity and data that we provide on this, I think the more it would be sort of appreciated by the ecosystem. And S&P is doing work in that space. We've partnered with WCMC in that, and we're also actively contributing to data around nature and biodiversity. So I think that would be immensely useful. In terms of how this would evolve in the future of climate risk analytics, I would say that there are approaches. It's too early, at this point. But yeah, that approach would perhaps need to consider. One is a company's dependency on nature. And that could mean for a company whose assets are located, near coasts, and mangroves are sort of protecting, flooding at this point. And if that dependency is destroyed on these mangroves, that means the asset is destroyed, right? So there's that dependency risk that one needs to, analyze. And then the other is impact. So whilst conducting one's business activities, are you destroying nature? At this point in time, there are fines and penalties in some sort of designated conservation zones. But if that's sort of set to expand, then how would that affect financial risk, lawsuits, legal risks that a company may face? So yeah, so there's work to be done in that space.
Thanks, Rana. Raphael, what about you as an insurer? How are you and your customers thinking about nature risk?
So same here, it's really new for us. We think about it in the same way, actually. It's both the dependency on nature, and so how nature risks can impact the business, as well as impact on nature. What I think is something that we're thinking about with clients is how we can learn from what's been happening on climate and learn the lessons and then replicate that for nature. My big reflection in the space is, especially when we thought about impacts of businesses on climate, really we've had to measure one thing, which is carbon emissions or GHG emissions. Here, I don't know how many things we need to measure, but it at least needs to include water, biodiversity, soil health, air pollution. And so I think we're still at a point in time where everybody is holding their breath a little bit to see exactly what we should be measuring and how we should be measuring it. Should it include more things like being on the ground, analyzing impact? How do we do that with the technology we already have versus having to develop new things? My worry in the space, and I think it's clients' worry as well, is that we end up going the same direction as climate, where I think somebody remarked yesterday that there are something like 70 different standards for climate, and that doesn't work, right? And that can't work in nature, otherwise we're all producing data and reports that aren't comparable and that nobody can make good use of. So I think in a way it's slowing everybody down a little bit because we're waiting for one master standard to emerge, and I hope that's the TNFD or some of the work that the ISSB has been doing since COP26. But yeah, it's been a little bit slow, and I hope that once we solve the standard piece, everybody can hit the ground running and really accelerate on that.
Ilya, so biodiversity is complex, and we're in early stages of trying to measure nature risk. What are your clients asking you? What are the questions that you're hearing, and how are you factoring that into, the solutions you build?
Yeah, well, is this one more? Yeah, there we go.
Yes.
Okay. Well, to be honest, I would say that in the Americas, a lot of my focus is with financial institutions in the Americas, and it is really early days. Some of them, I think, have really not started on it yet, frankly. I think a small number have been more engaged on the topic, but it's early even for them. Probably the European banks are farther along. Some of and I haven't worked as much on this, really very little, but my colleagues are doing work with the TNFD, and so I had the benefit of learning a bit from them on it. And one of the things that I've seen is, and when I think about this as a problem, it seems really tough, right? Climate, we have emissions as a metric, right? It's a very imperfect metric, right? And we've got the different scopes and the double counting and all these issues, but there's something there that one can anchor to. In nature, you know, from what I've seen, it's going to be hard to summarize all that into one metric, right? I think about, you can have different aspects of biodiversity. Maybe you can assign values and weight them, but all that is judgmental. And so in all likelihood, it's going to be multiple metrics that need to be considered. That adds to the complexity of all of this. But where I would, the other interesting learning I've had on the topic is that, you know, while the Europeans may be farther ahead on working on this topic than in the US, part of the work that we're doing is actually, it's a pilot with a number of banks in Africa. And in Africa, for the financial institutions, their climate doesn't quite resonate as much as it does in other places. They sort of, you know, the transition, there's not much they're going to do about the transition by and large, and it wasn't caused by them, and where it needs to be solved is kind of elsewhere to some extent, right? I think that's part of the perspective. But with biodiversity, that's a different story. That resonates much more. That's a resource that they have that they really need to preserve today. And so it's interesting to see that sort of dynamic, right? And I think that's going to be a driver of how financial institutions are approaching it in the different regions.
Thank you. We have a poll that I'd love for you to participate in. For those of you who managed to download the app, we have a question for you all. What are the biggest barriers to investors and corporates in understanding physical risk? And if I could see the screen, I could read what faces are mapping to what results, because some of you look surprised. What's that? Oh, there are no results. I'm sorry. Okay, people, we want to hear from you. Maybe we'll do a show of hands. Okay. I'm not sure what the choices were. Can't see the, here we go. Yes. Oh, here, I'll read it. Okay, so lack of geospatial data on location of assets. Let's see a show of hands. One hand, okay. Translation of physical risk into dollar impact. Okay, got some more hands there. Lack of data on how climate change will impact physical risk. Okay. I think I saw someone raising their hand twice. Lack of appetite to better understand. Thank you. So thanks for that. So I want to thank our panelists for such insights into what you're seeing from your clients. It sounds like it's early days for biodiversity and nature risk, but as it relates to climate risk, physical risk, there's a lot of work, good work being done. And it sounds like with the levels of sophistication that the market is going on in this journey, there's a lot more work, there's more tools. Asset level data is important to being able to get more granular and really get into the underlying analysis. So thank you so much for your views and your insights today. Appreciate that. Let's give a round of applause for our panelists. Okay. So I think we have another short break, and we are now tracking on time, so thank you for that. We're going to take a 10-minute intermission, so if you can all come back here in 10 minutes, and if you want to download that QR code now, it's a great time to do it. Us inside, please. I don't want to disrupt your flow. Come on in. Come on back in. That's what happens when you have intermission outside in beautiful weather. People don't come back. All right, guys, we're going to get started. Thank you. So next on our agenda, we have a panel, and we'll be discussing aligning financial markets with net zero. And the panel will be moderated by Ben Leo.
Great, thank you, Sonia. It's great to be here. So I would say aligning financial markets with net zero has certainly been a very hot topic at this COP already. I'm sure everyone has already heard a fair bit about it. But just to really highlight what's going on at the moment, the most recent figures we've heard coming out of G-Funds are that we have 130 trillion US dollars of assets that have commitments to be aligned with net zero, which is really quite an unprecedented number, extremely large. I work within our indices business, and I know from our perspective we have done quite a bit of work already on net zero. So very recently we launched our S&P carbon budget indices, and they take an approach based on the latest IPCC report, and they try to give an index a pathway towards net zero based on the remaining carbon budget with an 83% probability of limiting warming to 1.5 degrees. This is an index series that very much has a focus specifically on decarbonisation. We also have our S&P packed indices, and these take a more multifaceted approach. So I think we've heard a lot today and across COP generally about how we really need to be looking at more than just decarbonisation. So this incorporates physical risk, it incorporates forward-looking perspectives on net zero, it also incorporates E, S, and G more broadly. But this does mean you need to take on a little bit more active risk. Very specific to this session as well, we've recently launched indices in the fixed income space, so a similar product to that of S&P packed indices, and we also have green and social bond indices. So fixed income itself is, I think, really quite interesting for a number of reasons. So firstly, a rising rate environment. It's very appetizing to investors from that perspective. They potentially have more direct impact that they can have, and also naturally the proceeds of green and sustainable bonds. So firstly, to introduce the panelists here today, Marcus and Bernard. Marcus, would you like to go first and introduce yourself?
Hello, my name is Marcus. I'm head of sustainable bonds and finance at DZ Bank. DZ Bank is Germany's second largest bank. What are we doing in sustainable finance? More or less, we have two tasks. One is to help issuers along the entire value chain of a sustainable bond transaction. It can be green bonds, blue bonds, social bonds, sustainability bonds, transition bonds. We are talking about a little bit later. On the other hand, we are also helping investors to integrate ESG into their investment decisions, from a, let's say, very easy ESG integration up to really setting up dedicated portfolios and dedicated allocation policies.
Yes, so I'm Bernard de Longial. I'm the Global Head of Sustainable Finance for S&P Global Ratings. Sustainable Finance at S&P Global Ratings is a team which is responsible for three things. First, we are a center of excellence, which is helping our credit rating analysts to integrate environmental, social, governance risk in credit ratings. But they are doing it, but we are increasing their capacity to assess it in a forward-looking way. We are also rolling out a suite of sustainable finance products, such as second-party opinion. We have an ESG evaluation, which is a kind of ESG rating. We are also a research center working with the credit rating teams and across the divisions to produce sustainable finance research.
Yeah, thank you both. Very interesting. So first question for the two of you, maybe Marcus first, is why is it important for organizations like yourselves, like obviously S&P, to be here at COP?
I mean, for us as a bank, you know, we are in the race for the trillions, and I think our role of banks has changed from a classical financial intermediary to more sustainable finance intermediary. And we are here really for, you know, allocating capital in the right into sustainable solutions, more to say. We are also here for exchanging ideas, also giving education. I mean, sustainability is a kind of learning process. And yes, I mean, we are here, we are networking with investors, we are networking with issuers, with the investors community. We are also had high-level politics talks here, and yeah, to make everyone aware that we should not lose this race for the trillions at the end of the day.
Same question for me, I guess. First, I would say that why are we at COP? We are first acutely aware that for us climate change is the biggest challenge for our generation and the key focus for market participants. And as a major data and a climate insight provider, we believe that we can play a role in enabling and accelerating the transition to a low carbon economy. Being here in Sharm el-Sheikh this year is also important. I think it's a stark reminder of the big adaptation and mitigation financing gaps for low and middle income countries. You know, we released a research a few months ago about physical risk on a 250 horizon, which was showing that developing countries are 3 times more exposed to physical risk on a 250 horizon in terms of GDP exposure than OECD developed markets. Moreover, if you think about transition, more than 50% of the global greenhouse gas emissions today are taking place outside the OECD, which means that no transition will take place without having the developing economies transitioning.
And staying with you, Bernard, what is the role of sustainable debt, or what is the role does sustainable debt markets play in financing the transition?
Look, when we look at the sustainable debt market, we would say that it's playing a growing role, and we believe has a lot of potential to contribute to finance this transition. It's a market which has grown enormously. Between 2018 and 2021, it grew more than 5-fold to reach more than 1.5 trillion. I'm talking about the sustainable debt market, of which 2/3 approximately are focused on climate-related investment. It's a market which has proved to be very innovative, where you can think about the traditional green bonds, which allow to finance green assets like renewable energy, like energy efficiency investment, but also with the sustainability-linked type of products, you have now tools which allow to finance, corporate strategy, decarbonization strategy, using targets such as reduction of Scope 1, Scope 2, or Scope 3 greenhouse gas emissions. And so this is enabling a much broader corporate issuers to access this market. Now, I would like to mention 2 things with regard to this market. First, this is COP, which is with a big focus on the need to address this financing gap for the low and middle income countries. If we look at this market, it's not been effective in supporting the transition and adaptation gaps for low and middle income countries. And we believe that unless we change the ecosystem, this market will not be deployed at scale to help the developing economies. Among the key elements which are needed is clear transition strategies at country level. You need change also in regulation to provide more transparency and integrity to this market. But also there is a big information gap. These are very small markets, and for investors, the investment need to understand is big. So you have an information gap, and you also have a country risk gap. And we believe, and that's a positive trend that we are seeing at this COP, that multilateral development banks can really play a role in enabling the sustainable debt market to grow by addressing these information gaps and by providing some equity tranche de-risking to making this market bankable or accessible to sustainable debt market. You have plenty of profitable investments across these markets. Now, if you address these elements, it can be done. The second element, which I think is really important and that we saw this year, is this is still a very immature market. So I'm talking about the sustainable debt market, where we are still seeing a lot of confusion, lack of discipline in structuring these green bonds, sustainability linked, and this gives rise to accusation of greenwashing. and this can undermine confidence in this market. So we believe that it's really important to increase the discipline in this market if we want it to grow to its full potential.
And you mentioned greenwashing, you've mentioned some of the criteria already for how a bond could be considered net zero, but are there other elements there as well?
Well, if we think, we are talking about net zero. Currently, there is no commonly agreed criteria across the sustainable market to define what's a bond aligned to a net zero. There are some transition bonds. ICMA has really some guidelines about what it would be to be a transition bond aligned. But what we should look at for a bond to be aligned to net zero, you should look at the issuing entity. Does it have a transition plan to net zero, to align to net zero? Is this addressing the key transition risks related to its sector? Is there a credible action plan to deliver? Ideally, are these targets, science-based? These are among the features you should look at to consider that a bond is aligned. So look at the issuer and go through these points. Yeah.
And on that note, how many bonds do you believe are actually aligned with net zero?
Look, on this, you have some safe-labeled transition bonds, but which are really a tiny part, and I know we will talk about them later, but they are less than 1% of the sustainable market, so very small, and they are self-labeled, which means that there is a need to dig deeper. Having a label doesn't mean that you're aligned. Now, if we look at more broadly, if you look at SBTi, currently the companies which have SBTi validated targets account for 35% of global market capitalization. And this gives you an idea about a potential proportion of bonds which could, let's say, pretend to be aligned. Now, being validated by SBTi as a target doesn't mean that you're aligned, because SBTi would not validate your strategy, would not look deep into your action plan. So some additional work needs to be done to understand whether the bond is really aligned and the corporate has effectively not only a target, but strategy with intermediate targets and an action plan to deliver.
Yeah, thanks. Very interesting. And Marcus, turning to you. So what debt instruments can help build net zero portfolios?
Well, actually, I mean, in my opinion, transition bonds really have the potential to become an asset class of its own within the sustainable bond world. Why? Because, I mean, when we talk about impact, where do we create the better positive impact? By, let's say, painting already dark green things a little bit greener, or by really helping to move brown or critical business models to become light brown, light green, or green. So this is why I think this is the future of sustainable funding somehow. We can more or less use both famous structures of the market to do it. We can do use of proceeds transition bonds, where we say, for example, the proceeds are really for financing a dedicated transition technology. Here, of course, we always have the question about, do we have enough assets? I mean, normally you have to have at least 500 million, 1 billion for this use of proceeds. And then we talked already about target-linked financing, and I think this is really the biggest potential in the transition bond market. Target-linked financing, you have to define 2 or 3 material KPIs, you underline them with some ambitious transition targets. They have to be ambitious, not the business as usual, a little bit above. And then you have a kind of coupon set up. If you miss to fail the targets, the issuer has to pay more. So this is, from my point of view, a very credible model. You don't have to use or have so much assets at the end of the day. And the good thing here is, I mean, we already see it in the corporate sector very much emerging. For example, in Germany, when we were talking with corporates and about sustainable funding, already 90% of all the structures are using this kind of target-linked financing at the end of the day.
And maybe if I can, because what Marcus described, which is you need targets, you need well-defined, is something really which is important, because when you think about the sustainability linked, the target linked, as you say, market, it's a market which is currently heavily criticized, and it's criticized, I would say, as a result of a lack of expertise, understanding of many of the market participants, the corporate issuers, which set up structures which do not necessarily address the key material sustainability factors. So they are, you may have the ambitions. Some of these targets are not necessarily additive, compared to business as usual, providing really a step up. So targets are like business as usual, and you would say that if you're doing something which is business as usual, the bond would not qualify for being sustainable. When we talk about targets, sometimes we look at the structure. These targets sometimes are set very late, potentially too late. So I think the instruments is very good, but implementation is key. And if really we agree that this is an instrument which has potential and the need is big, but without discipline, we could really undermine its development.
And Marcus, what is the investor uptake on the transition bonds specifically?
We see a very interesting, I would say, new credo among many investors saying transform instead of divest. In the past, when you had sustainable investment decision, it was more like a black and white decision. Either it was sustainable or non-sustainable. If it was non-sustainable, it didn't fit into the portfolios. This has changed. Now investors are more forward-looking. They want to identify, the champions of the future, so to say. So they are saying, okay, we are investing in even, as of today, critical companies, but we know they're on the right transition path, and it's a credible transition path. They become a banking, or the investors become a kind of partner of the future, more or less, to say. And this also translated a little bit in a more, let's say, active role also of fixed income investors. There is really an engagement between the corporate they finance and the investors by themselves, either alone or in coalitions. And this is really, a new kind of investment class. The good thing is, in the old times, when you look at a very narrow, sustainable investment approach, you don't have much bespoke choices. Now you have better choices. And even transition financing can be done in two ways. Some investors are really looking at this explicitly labeled bonds, and others say it's more important the issue behind, the transition potential of the issue itself. And so we have a lot of various choices for investors nowadays.
And what is your typical investor in green bonds, and does their profile really differ from the usual investor? Okay,
green bonds are the most matured market since 2008 when the European Investment Bank opened it. We are now also seeing a lot of central banks, for example, buying into green bonds. We have a lot of different institutional investors, so it's a very broad investor community. Here, when it comes to transition bonds, it's, I would say, typically institutional investors. It's nothing for central banks yet, but I think this might change for the future. Because I've been into Asia currently on a roadshow for 10 days. We spoke to a lot of central banks and regulators, and in every meeting, more or less, transition financing was one of the hot topics, and also target-linked financing. So I think there is a potential. We see a lot of investors, especially also in Germany, investing in this target-linked structures. We also have in Germany this smaller Schuldscheins, promissory notes, which only have smaller amounts, 20 million, 50 million, 100 million. And here we really see already 90% of all bonds being a kind of transition-linked bond.
Yeah, thanks. Very, very interesting. And back to Bernard, back more to the corporate side. How are financial service companies rising to the challenge of these net zero commitments?
Well, first, as you mentioned that at the beginning of the panel, yes, we're seeing, if you look at the Glasgow Financial Alliance for net zero, the level of commitments are very high. If you think about the Net Zero Banking Alliance, we have now more than 120 banks which have committed, are participating to this alliance. Now the challenge is to translate these long-term commitments into intermediate targets and short-term actions. And if you look at the banks in particular, only a few banks currently have been able to set up intermediary targets, thank you very much, intermediate targets, and these targets have been set up at sector level. They are not covering the entire portfolios, and these sectors are, coal, oil and gas, a few high emitting sectors. And this reflects, I think, the very specific challenge the financial service industry has to address. The first one is that the greenhouse gas footprint is 95% related to scope 3, indirect, and this is the one for which the information gathering is the most difficult. Second, in order to be aligned, you're reflecting the economy you're financing, so you need to have a grasp on your customers' transition strategies. And these transition strategies have not necessarily been set up already, or when they've been set up, they're not really transparent, so you need to engage and understand. And the third element, yes, and you are somehow reflecting the shape of the economy. Now, what are they doing? What are the banks doing with this in mind? It's a kind of integration of climate at corporate level, which means having a clear governance about a climate ambition, and fitting it into the underwriting and investment strategy, which means understanding the exposure of your customers, the opportunities and risk, their transition pathways. Banks and we heard that earlier also, are working on sector-level transition pathways, engaging with their customer to understand to what extent they're aligning to these transition pathways. Engagement is prevailing. We are seeing, exclusion is currently really limited to a few sectors, which, again, you can't transition. You can't transition coal, so you're going to exclude coal. But apart from that, it's much more engaging, and exclusion is more used as a last, because if a company would not transition, would be a clear laggard, then you're at risk to see a reduction in exposure. It's also about really pushing new products which are going to facilitating the transition. So it's, could be investment banking, green bonds, sustainable debt, underwriting, but it could be, creating special financing, loans, mortgage, or for corporates, or whatever, infrastructure. These are the kind of things that we are doing. As of today, if you look at the banks, we can't say that you can see a big shift in their balance sheet. It's very gradual. Now, you don't transition the economy. You can't just cut your customers, cut the lines. This doesn't work. It's about engaging, moving them. And so that's the challenge of the next years, to see how the banks are going to, at sector level, through this engagement, help and push this transition. You won't see it in the figures in the short term, but that's really the challenge that we're going to look at in the next few years.
So we haven't got long left, so in one sentence if possible, a much higher level question here. There are some that say 1.5 degrees is no longer achievable. Do you agree? Marcus, first.
I think it's still achievable, but we really have to push hard.
It's very unlikely, but I think keeping this target is important, because it's about mobilizing the entire economic system, and every half or tenth of a degree counts. So I think as a target, it's important to keep it.
Yeah, I totally agree. I think with the non-linearity, the tipping points, we really need to fight for every little bit that we can. Okay, well, thank you very much to both of you. Two very interesting, complementary opinions, I'd say there. So thank you very much.
Thank you very much.
Thanks, Ben. Thank you, panel.
And in population suggests that the biggest growers, the biggest engines for growth, are going to be South Asia and Africa. And this is where the challenge comes in, because if they start following the trajectory of the United States, 112.9 thousand barrels of oil a day per million people. Right now, India is 1/10 of that. So if they're going to follow the same trajectory, we're going to have a major problem. If Africa, this is 1/20th, this is 1/30th of the United States. If Nigeria or other parts of Africa start following the US trajectory, this is in no way sustainable. And what we know is that the greatest growth we're seeing is here and there. So, where are we going? Well, this is our 2-degree scenario. There is hope. You can see the colors. The US has gotten lighter as Africa is still staying relatively carbon, fossil fuel unintensive, even while we're seeing growth. We're still seeing challenges, but it's something that, this is as we run our models. We have our models for 143 countries, for 12 end-use sectors, for 30 different energy commodities. This is what it's telling us in terms of fossil fuel demand per capita. Key drivers. We can see demand for low carbon fuel. This is what has to grow. Because We're not saying energy, we're going to stop using energy. We're going to stop seeing energy growth. Energy has to grow. This is part of what an economy needs to thrive and survive. So we need these numbers to start going up. We need China and the US to start moving their low carbon fuel, which is anything ranging from renewables, from wind and solar, to hydrogen, to nuclear. We need to see that going up. So where are we? We certainly are seeing that going up. And this is our 2-degree scenario. And to the question that was asked previously, this is a scenario that we think is doable. You know, we have set scenarios that we model saying that we try to get to an endpoint. This is how you could get to it. This is a scenario that we actually see a feasible way of getting to that endpoint. So this is our kind of energy transition. People ask, what is the energy transition? So I just kind of daze them with this kind of moving, these moving pieces, but these moving pieces are actually legitimate. You can see the oil, natural gas, this is the renewable side, coal here. You can see the different sectors as they go through. You can see the end uses. And for example, you can see how oil starts, if I go to the prior chart, I'm going to do that. You can see oil going to passenger cars. Considerable 2030, big deal in 2020. This is our 2-degree scenario again. Once we get to 2050, that turns into a sliver. And you can also see where electricity is going into the different parts of it. Now, this is thousands of data points. This is just, I'm just trying to show it in 30 seconds. Happy to discuss afterwards. So what are the solutions? And this is something that our next speaker is going to be talking about. Is going to be talking about the hydrogen piece of it. This is what we're seeing. This is from our database of low and zero carbon hydrogen facilities. Hydrogen is happening right now. In terms of low carbon, not too many operating. I mean, there's a handful. We look at the big ones. We look at the big ones announced. We look at the big ones under construction. This is where the hydrogen revolution can come in based on the incentives that are coming in. And you think about, you look at where the incentives are coming, and we have this, there's the whole split of hydrogen. Is it going to be blue hydrogen that is basically created with natural gas, carbon capture sequestration? Is it going to be renewable green hydrogen, which is based on wind, solar, and renewables, electrolyzers, and hydrogen produced that way? You can see the split. And to be sure, that split is changing. We do expect that split to change further because natural gas prices have risen to entirely unprecedented levels. So certainly, renewables, particularly if they can be done on a dedicated basis, we expect to see more of these coming in. So where are we seeing coming in? Well, Europe, Fit for 55. Big announcement last year, and this was even before Russia's invasion of Ukraine. The incentives were there, the structure was there. Now the actual ways of executing on this are being determined. You can see Europe, very much commitment towards green hydrogen. UK and the Netherlands were among the blue hydrogen holdouts. Realistically, that's become much less of a proposition given that molecules of gas are so much scarcer in Europe. So the green hydrogen story is going to be powerful. We look at the Middle East. You think about all the potential and some of the facilities and some of the projects about essentially creating the hydrogen here, given all of the potential, the renewable potential, and then shipping it to the end-use sectors and the end-use countries that absolutely need it. So you can kind of picture demand flows, and if you picture the sort of tankers of oil that flow, we're going to be seeing tankers potentially of hydrogen, ammonia, or other derivative products serving this need for clean energy to get us to a 2-degree, 1.5-degree scenario. Australia, huge story there. Think about what Australia can provide. Super cheap renewables. I mean, the installation, the wind potential, phenomenal. Question is then, how do you get that translation to the markets that need it to get the decarbonization going? United States, this is an exciting story. I mean, I'll say Inflation Reduction Act again. I'm sure you've heard it 1,000 times, but the Inflation Reduction Act has created incredible incentives for hydrogen. So this is a dated data set. I haven't updated it. Updating it, we're going to see a lot more dots, a lot more green dots, because the incentive structure that's going to be depending upon the carbon intensity of the hydrogen, the tax breaks will depend on that, but it'll create massive incentives for that hydrogen to be created in the US. And it's actually going to create a bit of a competition, because all of a sudden Europe wants to get its hydrogen, the US wants to get its hydrogen. Only so much capacity, where's it going to go? When we look at these different facilities, I mean, we actually bring this down to a specific asset level. People were talking about asset level data. Well, we have this data basically on all these projects, asset level, be it on green hydrogen, be it on blue hydrogen. This is something that is, you want to look at this potential, look at the decarbonization potential. It's all here. It tells part of the story. The other part of the story, and this comes from the sort of Platts heritage of commodity insights, is to provide transparency in these markets. I mean, how do you actually engage and how do you actually execute on a strategy you may have around hydrogen, around metals, around low carbon LNG, around net zero aluminum? You know, you do this because you have markets that are tradable. You have market players that understand what that price is, and they learn to rely upon it and put it into their contracts. That's what we're looking to provide, to facilitate the energy transition, so it moves from being a concept to being an executable strategy. And so, you know, talking about hydrogen, well, this is also dated, but you can see what, you know, you can see what the price is for producing hydrogen, SMR with CCSR. You know, we have these prices on a daily basis. So you want to understand how it's changing, we can do that. Shifting gears, but not entirely shifting gears, electric vehicles. I'm going to bring this back to the commodity space. This is what we're seeing in terms of electric vehicles from 2020 to 2025. Massive growth. We're seeing the growth in North America, especially in China, Europe. Now, what do we know needs to happen for these electric vehicles to be produced, for them to be brought up? Well, you know, we need minerals. And this is one of the big constraints, one of the big perceived constraints, is the availability of the lithium, of the availability of the cobalt, availability of the nickel. Well, once again, this is an issue. Operating lithium facilities, not that many here. And if you're looking at that level of growth, you need a lot more of these facilities to be up and starting to produce, go through permitting, and actually be able to meet those needs. In order to be able to know how to finance that, to think about lithium producer, what am I going to be able to get in the market? Well, you need to know what the lithium prices are. So you need to have that sort of data on what is lithium carbonate, what is cobalt sulfate, what does it cost if this is where all the mineral processing facilities are taking place. Then you need to know what that is. You can pick your different facilities. Finally, and I said this was going to be a whirlwind because I don't know how we're doing in terms of time, in terms of our next speaker. So key thing to note here is energy transition. You know, we talk about it, a reference case scenario, a 2-degree scenario, a net zero scenario. The reality is, in most of these scenarios, we see oil staying as a, you know, we talk about phasing out coal. That's something that there's a pathway for doing. We talked about phasing out, we've talked about electric vehicles for passenger cars. That's something that is also, we see, as I just showed, a major opportunity to change. But overall oil demand, what are other sectors? Some pretty hard to decarbonize sectors. Long-haul trucking, hard to decarbonize. Aviation, hard to decarbonize. Some sustainable aviation fuels for sure, but still hard to decarbonize. Bunker fuels, hard to decarbonize. Not that there's not solutions. Hydrogen can be a solution there, or derivatives. So what we're seeing is, and actually the other piece of it, when we're talking about oil, is so much of oil demand, of the growth in oil demand, is about petrochemicals. So it's not about burning the oil. It's not about emissions going up because you burn the oil. It's because you're using the oil, processing it. There's emissions involved with that, and there's emissions involved in the upstream. So the other part that we're trying to provide information on, and this is something my colleague Paula can go into some great detail on, is understanding the upstream. You know, if you know this oil is going to be needed, and we know the oil is going to be needed under most of these scenarios, it's going to be needed for petchems at a minimum. Well, then you want to understand not just what the combustion of the oil means, but what does it take to drill for the oil? What does it take when you process the oil? What does it take when you ship the oil? What does it take when you refine the oil? So ultimately, you know, this is what we're seeing. We're still seeing, even if this is in our reference case scenario, a good deal of oil use in 2040. So what do we do about that? Well, we need to understand what does it take in the upstream? What does it take to process the oil? What does it take to drill for the oil? What does it take to complete a fracked well? We're seeing a lot of upstream oil fields, and this is gas flaring. This is one of the pieces. This is not about burning oil at the end. This is just about getting the oil or the oil products to where you can use them. So you can see the differences here. We're, you know, obviously in the Middle East, the Permian in Texas has gotten a lot of attention because Europe was considering whether they actually wanted to be purchasing oil with this high carbon intensity. So big question, both for purchasers of oil who want to show that they are actually scope 3, you know, in terms of what their emissions are and what the emissions of the processing are, but also from a country level perspective. I mean, these are emissions that are going against NDC targets, and and countries want to have a strategy for dealing with them. I think HOP has been very good about last year, first time setting methane objectives, and this year, hopefully, and I believe actually they're going to be tightened. We may see something today or tomorrow. So, Permian, this is all done with satellite data. This is something that we also process. We can provide essentially well and ultimately grade level detail. We call it as being part of our Platts periodic table of oil. And you can categorize all this. You can categorize oil by its gravity. You can categorize oil by its sulfur content. So we just added another attribute, which is carbon intensity. So for every for every oil, you then can understand what does it take, how intensive is it from a carbon perspective to bring that oil to market. And what you can see is there's a very wide range. And where's I don't show the range here. I show the scaling. I think I may have it on the next map. Okay, I mean our lowest one, and these are our absolute lowest ones. These are some of the ones like Johan Sverdrup, which are essentially using electricity to power their rigs, brand new field. It's also partially how old the field it is and how much methane is just naturally released in what stage in the process. But there's a huge difference. And medium carbon intensity, and this will give you a sense of the differences. Less than 15 kilograms of CO2 per barrel of oil equivalent, 15 to 30, and then the huge ones are over 30. And
are those basics, or what is each square?
Paula.
Okay, yeah, so I can help with that. Sorry, hi, Paula. The pricing team, so I work very closely with Roman. So they are done by grade, sorry, not by grade at the moment, but by field specifically. And then we've also released for the BFOE grades, as well as for WTI Midland, a full basin outlook, as well. Oh, sorry, I thought I was projecting pretty well.
You are.
Okay, anyway, so we also have some grades as well. It's about sort of building up that transparency. We're looking at various other places to get that whole grade system up as well. We need all of that field data, and that level of quality information is not fully available outside of the US and Europe in the same way. Happy to answer any questions about it. Great.
Yeah, so work in progress. Like I said, we've tossed in, I don't know how many hundreds of data sets in here, but this is among them. And to highlight the differences, Johan Sverdrup up here, tiny green, less than 15. I think it was below 1. Johan Sverdrup, is that right, Paula? Orinoco, greater than 1,400. So if you're thinking about where to buy your oil from, and that's a consideration, then we provide the data to help make that decision. And yeah, so detail on Johan Sverdrup, detail on Orinoco, those are two bookends for us. So if you want to understand, and to be honest, this is something that we're using this as an example. We're using crude as an example, but this sort of carbon intensity, apply it to whatever commodity you want. You can apply it to LNG, you can apply it to wheat, you can apply it to biofuels, you can apply it to steel. Everything comes with its end-use product, but also everything that it took to bring it to market. But,
are we starting to see pricing differentials reflecting that?
I think Paula's the right person to answer it. And just for full intro, Paula's from our pricing team, I'm from the analytics team. So we work closely together to first of all understand the markets that we're talking about, but then also to bring that understanding into a pricing perspective.
The answer to that question is to a marginal degree. It is starting to come up as part of the topics of conversation. So if you have a very, very low carbon intensive barrel, such as the ones at Johan Sverdrup, they do use that as part of the sort of marketing of that barrel, and people do make those purchases with that in mind. I think as you sort of include and grow that carbon intensity conversation, you're also going to have to factor in what the actual carbon intensity is in the refined products that you generate. And a lot of those barrels are heavier too. So that's going to be a big part of how that market kind of evolves and develops going forward as well. But that's a big part of how Johan Sverdrup sells their crude, but it's not obviously how, and some of the other light sweets will also kind of play up that, and you will get a small premium for that, but for the most part, it's still not quite an attribute. It's just kind of flirting with the idea.
And just this is one example. I mean, in the U.S., there's a methane certification program where end users can differentiate the type of gas. So this is really about the availability of information. Once you know pick your commodity, how it was produced. You kind of have that passport of all the attributes that it took for it to get there. You can then have end users decide. You can have banks decide. You can have financiers decide. How does this fit up? How does this roll up into a portfolio? And then we actually have some corporate emission solutions tools where you can then compare and look at the assets you can add and see how that changes your overall portfolio makeup. So lots to talk about. Happy to answer any questions. And I think this is actually a great segue because we kind of talked about some of the solutions. And hydrogen being a key solution, renewables being a key solution, I think at this point we should talk to people who can make that hydrogen, make those renewables come to life. So I don't know, with that, maybe Richard, if we can bring, the people who can bring our hydrogen and renewables to life.
Okay. Roman, that was amazing. Talk about a picture telling saying 1,000 words. I think you showed us many pictures.
1,000 pictures.
Hundreds and hundreds of thousands of data points, I'm sure. Thank you for that. So we're ready for the next session. I'll introduce you, Richard. We're going to have a fireside chat with Richard Madison, who you all met earlier, and Marco Alvera, Group CEO of Tree Energy Solutions.
So I'm very excited
to introduce Marco. Marco was the CEO of Snam, a major gas company in Europe, for many, many years, and an S&P Global board member, the promise for the future that we need in this debate. So previously, Marco, we just saw an atlas of the energy future, if you like. So I'd like to say that you're part of the energy future. So Marco, I know that you're really passionate about energy. The world needs energy to grow. Every human being needs access to safe, clean, and affordable energy. Can you just debunk some myths? Tell us about the things that people say about, for example, hydrogen or renewables, and tell us what you think about those things.
So I think the biggest obstacle to really understanding energy is that we use different currencies for each thing. And so I think S&P has a role with all your publications, and I say this to every journalist I meet, we should go away from pence per therm, dollars per million BTU, dollars per million cubic feet a day, billion cubic meters, barrels, tons. No one understands really how to compare across the energy spectrum. We can just move everything to kilowatt hours or megawatt hours, and that would just make everyone's life a lot simpler. And I've been 20 years in the gas industry. I still need to take out my conversion table to go from BCF to cubic meters to BTU. And then pence per therm. I mean, who really knows what a pence per therm is? And you read, you open up the Financial Times, it says the MVP went up 3% to 2.8, whatever that number is, pence per therm, whilst the TTF is down to 100 euros per megawatt hour, and the Henry Hub is admitted. It's just, no FT reader knows what those numbers mean as you relate them to each other. So if you put everything in megawatt hours, you discover some really incredible things. First you discover, and I want to give credit to my friend and partner, Paddy Padmanathan, who's the current CEO of Aqua Power, and he's stepping down from Aqua to join me in Zero, and we can talk about what I'm doing. But we call him the Usain Bolt of solar. So Paddy really got solar to go below $50 per megawatt hour, and then below 40, and then below 30, and then he was trying to get below 10. He stopped at 10.4. So we now have the cheapest solar auction on record was won by Aqua Power in Saudi Arabia at 10.4. You have another one in Dubai at 11. You have one in Portugal at 13. And people don't really realize how profound this is, because solar was at 1,000. And to go from 1,000 to 10, and this is over a 15-year period. In that same period, natural gas global average went from like 7 to like 80. So you have natural gas at 80, and then you have electrons at 10. And so I think this is just the myth. And then we can talk about hydrogen, the complexity of hydrogen, but this is the biggest thing. This is a huge, incredible, massive business opportunity. Forget climate. for a second. This is just a huge arbitrage that is structural. Because, okay, now maybe the 10 is up to 20 because of supply chain issues, but we'll soon go below 10, and then we'll get to 5. And this is because of the CapEx remuneration. But if you actually look at the marginal cost, which is where energy systems tend to run at, what's the marginal cost of the sun? 0. So these electrons are going to get cheaper and cheaper and cheaper wherever it's sunny and windy. And the molecules are going to get more and more expensive as we run out of the cheaper reservoirs and we drill for more and more expensive stuff. And by the way, people aren't drilling anymore. And by the way, investors don't want oil companies to drill, and oil companies are going to have massive cash on their books, and governments are going to try to take that cash. And so oil companies are going to end up buying renewable companies, and that's all really interesting. So I think that's the first issue. The second myth, and I've finished, is really that people see a lot more complexity in some of the hydrogen and hydrogen derivatives, and people because people are looking at it from a utility perspective. I've had the luxury of working both in NL, a utility, and in Eni, a big oil and gas company. And I can assure you, building an ammonia plant, a hydrogen plant, an e-methane plant, which is what we're doing, is just a lot simpler than drilling for oil in the sub-salt offshore Brazil with waves of several meters and tides. And, it's just orders of magnitudes of simpler. So oil and gas looks simple just because we've been doing it, and people don't really understand what's happening below the ground until the Macondo happens. But that complexity of the subsurface, of the geology, of the uncertainty of the seismic, you just take all that out. It's about just putting bits of steel in the ground. It's actually quite simple.
So simple infrastructure and a massive price arbitrage. I mean, that sounds like a huge opportunity for investors.
Yeah, I say this is forever infrastructure. People say a lot of the infrastructure is stranded assets, the pipelines, the LNG terminals, as we convert that. But as we build new infrastructure, as we build an electric cable from, say, Tunisia to Rome, or even Morocco to the UK, like we're trying to build, like Paddy's trying to build, that is forever infrastructure. That's like a Roman aqueduct that was built 2,000 years ago and is still operating. By the way, same as sun and wind. Water has very low marginal cost if it's coming out of the spring. So this infrastructure is not about the energy transition to something else. This is about the kind of the eternal solution.
Yeah. So you have two new companies. You have Zero and you have TES. Love to hear about both of those.
Okay, so a year ago in Glasgow, I was with the Usain Bolt of solar. Luckily, he's not as fit as Usain, so we were walking in the countryside above Loch Ness on the holiday between the 2 weeks of COP. And I was telling him about, we've known each other for many years, I was telling him about how difficult it was to continue a trajectory of acceleration in SNAM. I joined SNAM with a full mandate from the government in Italy, very, very supportive board, and a company that's generating 2 billion of cash every year. So I joined SNAM to turn SNAM, I thought, into the Amazon of energy, using the platform, the competences, and the cash flow. And I got to a point, but then to really accelerate, you just have a drag. It's like getting an oil tanker on a plane. It's like yeah, the DNA of legacy assets, of companies. It's just much harder to disrupt a sector if you're in the sector. That's why Tesla disrupted automotive, and it wasn't Volkswagen or Ford or EasyJet or the fintech. So you could go on and on. And Paddy in a way had done that with Aqua, but Aqua didn't really start out to disrupt. It started out to make money. And we both had a real sense of purpose, and this incredible gap between the action and the ambition in all these COPs, and the gap gets bigger and bigger. And we were working together on the NEOM project, which is the world's biggest hydrogen project in Saudi Arabia. We were supplying the electrolyzers, he was supplying the solar energy air products, just taking away the ammonia. And so we just said, why don't we start something together? We work out of first principles, we bring in the best engineers, the best developers, the capital is available. And so Zero is really a partnership between myself, Paddy, Alessandra, to develop big projects. like neon-like projects around the world. And TESS is our first project. I'm fully dedicated to TESS, so I'm CEO of TESS. And TESS stands for Tree Energy Solutions, but it wants to recall Tesla and has the ambition of becoming a Tesla of energy. And the good news is that we need several dozen of these disruptive companies, because if you just look at any statistic, we need, I think, 50,000 gigawatts of solar and wind capacity. You'll know better, but there's a number that is incredible. So TESS is building Europe's biggest LNG terminal, but we're going to gradually replace the LNG with ENG. And ENG stands for electric natural gas. It's completely renewable methane that we produce by merging hydrogen and CO2. So we create this molecule, which is cheaper than fossil methane, completely renewable, and incredibly abundant. So we're hoping to produce it in Australia, in Texas, in Mexico, in Egypt, in the Middle East. There is a huge market for it. And what this magical molecule does is it takes a lot of the issues with hydrogen. How do you transport it? How do you store it? How do you bank it? How do you insure it? How do you burn it? How do you consume it? How do you know what it is? Is it blue? Is it green? Is it gray? We're turning all of that into a product that everyone knows what to do with, how to store, how to trade, how to ship, how to insure, and most importantly, how to bank. People underestimate the complexity of getting projects sanctioned because of the bankability. So in a nutshell, Zero and TESS are working to make a lot of the renewable projects bankable. And then once they're bankable, we attract third-party capital in many of these projects.
Amazing. I mean, clean hydrogen, e-methane, there's 7 gigatons per annum by 2050 that could be saved with clean hydrogen, according to McKinsey, which is 20% of human-driven emissions. So big difference that could make. We have in Europe a taxonomy. The taxonomy is a classification of things that are green. That taxonomy has been linked to the COVID recovery fund in Europe. So it's about a third of that fund is available for green projects, basically. And that theoretically should result in a cheaper cost of capital, because the design of that taxonomy and the link to the recovery fund is to crowd in funding. So how much do you expect the transition, the things that you're talking about, the things that you're working on, to be funded with a cheaper cost of capital once you demonstrate they're bankable?
I think the good news is the capital is there. I mean, the public markets are a roller coaster right now for reasons that are obvious. And I think the private markets are very healthy. And when a project is bankable, there's just so much liquidity, as I said, building up not only in the oil companies, but also in the Middle Eastern sovereign wealth funds. I think the pension funds are sitting there looking to really deploy billions and billions of dollars into these products. So I don't think it will be necessarily the European subsidy. I think the IRA is going to have a huge impact, and I think Europe still has to really define how to make its money available, how to make the money that's available investable. So I speak a lot to the Commission. They're working to figure out the contracts for difference. I expect news in the new year as to how that will work. If I were a policymaker, and I'm telling many governments this, the real bottleneck to all this arbitrage between the $10 electron and a $150 TTF, the bottleneck is the availability of solar panels and electrolyzers. Like, governments should really put money on manufacturing. That creates jobs, creates supply chain certainty, gives these countries a competitive advantage, and helps front load the lowering of the cost. What we did the first time around 15 years ago, four generous countries, UK, Germany, Spain, and Italy, put 1,000 billion euros of subsidies at $1,000 per megawatt hour. 15 years later, we went down to 10, so it worked. But it took 15 years, and no jobs were created in Europe. These subsidies were put on people's bills, which is really unfair. That's really a regressive way of taxing stuff. But that resulted in 6 factories being built in China. I mean, probably a bit more, but 6 main ones. And if you look at the cost of building a factory for solar panels, it's only like $500 million or $1 billion at most. So you're looking at a capex, 1,000 billion of subsidies result in 5 billion of capex in China and 15 years. I'm much more in favor of spending the 5 billion in Europe or the US, front loading that cost reduction, and then saving the subsidies.
And you mentioned solar and electrolytes. Are there any other areas that you would put subsidies?
Yeah, I think wind, there's some very interesting kind of big, mega new wind design, and the whole logistics around that. It's the type of stuff that, if governments got really serious and organized, and you don't need every government, you just need 2 or 3 or even just one big government to lead the way. With a military type approach on R&D, on mega planes being built, it's not difficult. I'm too busy on my stuff to do that, but we need an Elon Musk, instead of going to Mars, to just build a massive plane to take massive blades and have onshore wind in Iceland. I mean, there's just a lot to do. You need to break the mold and to think big, but the good news, it's doable. Why don't we have a mega plane? Why don't we have big floating, how do you call them, the aerostat? There's a lot of ways. The question is just the logistics, right? If you put onshore the same size that you do offshore, the cost of that wind would just be incredibly cheap. Why can't you do it? Because there's a limit on the roads that can turn and what you can put on a truck, and that limit has been reached. So now we need to drop it in from the air. That's just one concept, one idea. But I would put government money really on lowering the costs, because that's just a benefit that filters immediately into society, and again gives a security advantage, a competitive geopolitical advantage, and a technological advantage. And China's doing this, by the way. And China's really doing this in every piece of value chain.
So it sounds like giant freight planes are sort of required. So I have one last question, and then I'll open it up to the audience. So think of your questions as I'm asking this question. How much can you use existing infrastructure for green hydrogen?
So we were the first in the world to blend green hydrogen with CH4 in an existing pipe in Italy. We delivered it for 3 months, I think, or 4 months, to a pasta factory. So we had the first hydrogen pasta in the world that was made with real green hydrogen blended into the pipe. So we proved, and we went all the way up to 20%. So that's easy. And we did the same for storage, by the way, to store hydrogen into the existing gas reservoirs. What we're doing now, though, with tests is this E&G. The beauty of E&G is you're reusing. You're not even reusing. I don't know how to say it. You're just using, because it's exactly the same compound. E&G is chemically indistinguishable, apart from the fact that it's pure, to fossil CH4. It's the same thing. So it's not about converting or which parts you just use the entire thing. If you think that we have trillions of dollars of ships, terminals, receiving terminals, liquefaction terminals, boilers at home, factories, pipes, you can reuse a lot of that. Now, I don't say that too much, because then you get people really nervous that we may be slowing down the rollout of heat pumps. I love heat pumps. I have a heat pump. But I go cautious with, I'm now focused really on heavy industry. But if you actually think about it, this is a very neat way to decarbonize just normal heating. Then you'll need to top up the CO2 with DAC or biogenic CO2. There's many ways to do it.
Great, wonderful. Do we have any questions in the audience? I have one there and one there.
Just speak up, or
maybe just
Yeah, no, just would like to hear from someone that's lived in the energy industry for so long, and you didn't mention it once. So just curious for your thoughts on nuclear and good, bad, myths. Where do you see that?
So I love nuclear. When I was in NL, I was trying to get Italy back into nuclear, so we had an agreement with EDF. If you look at what's happening in France, you get mixed feelings. The plants are undergoing maintenance unexpectedly, and the new plant that should have come online in 2010, then it moved to 2015, then 2018, then 2020, it's still not up and running. And if you look at Hinkley Point, at best, that will cost 115, 120, 130 pounds per megawatt hour. We can get renewable energy base load 24/7 from Morocco to the UK at around 48 pounds per megawatt hour. So I love nuclear if Rolls-Royce pulls it off to standardize, miniaturize, and really cookie cutter scale up the manufacturing and deploy to places where you're far away from the sea, far away from sun, far away from wind, like Canada. Why not? I mean, nuclear is good. Nuclear is also great for hydrogen, by the way, just to go behind the meter and use that as a source. So I think nuclear is great, but you know, with solar at 10, we say PPWS. That's all you need, PPWS. PPWS is a trademark we have that stands for put the panels where it's sunny. That's all you need to do. And you need a lot of land. And people always say, oh, we need to cut the red tape and the NIMBYism and the bananaism and you know all this stuff slowing down the deployment of solar or wind onshore. I just always look at population density. And you know, countries like the UK, like Germany, like Italy, have like 200 or 300 people per square kilometer. If you take out the forests and the mountains in Italy, you get to like 400 or 500 people per square kilometer, which is the same as Belgium and the Netherlands. The global average is 30, US is 35, Texas is like 11, and you go to countries like Namibia, it's like 3. Right, Namibia is like, you know, 5 times the UK and it has 2.5 million people. And the government owns the land. So just PPWS, there's plenty of sun, there's plenty of land. The land is all broken up because they were digging for diamonds in the 30s, so it's not as if anyone has any claim to that. It's just government. You can't actually access half of the country. It's just government fenced land, which is there, just being wasted. Let's just put some panels there and crank out some ENG and move that into Germany. That's what we're doing.
So if you want to quote anything Marco says, please put the hashtag PPWS. Ilya, I think you had a question.
Thank you. So just a quick question. The carbon, where is it coming from in the ENG?
So the carbon comes from our customers. So we started by, so we're building this terminal in Wilhelmshaven. It's huge. It's 30 BCM, 20 million tons. And the terminal is going to start in October 23 with an FSRU. And we started before the war, but the war has massively accelerated the fast tracking of the permits because Germany needs LNG. So we won't have the carbon from our customers before 26, 27. But so we'll start by bringing in fossil LNG, and then we'll take some CO2 from Australia for the first volumes of Australia ENG. So you capture it in Australia, merge it there and then it just released in a power plant. But we started with the intention of using an ATR to recreate the hydrogen in Wilhelmshaven, and then have a hydrogen pipeline from Wilhelmshaven go into the big backbone they're building in Germany. And when we approached customers to talk about how much cheaper our hydrogen was than the one you could get from cracking ammonia, for example, they started saying, why don't you give me the ENG, and I'll give you the CO2 back? Because that way I don't need to change my factory. That way we don't need to wait for a hydrogen backbone to be built. And I have to do CCS anyway because I'll have a lot of CO2 coming from gas. So they are going to be longer CO2 than we need for the ENG, if you see what I mean. So the deal is very simple. Take a power plant, I give them ENG and they give me back the CO2. Because the ENG is growing over time, so we have 20 years from now to 2043 when fossil gas is cut off from Germany. We have 20 years to go from 0 to 100% ENG in that mix. So we're going to be structurally long CO2. So part of that we'll need to store, or if they want us to store it, fine. If not, they give us only part of the CO2. The problem arises in 2042 when they're fully decarbonized. The efficient process only captures about 90%, as you know. If you want to get CCS to 100%, that last 10% costs you more, or 3 times more than the first 90%. So that's when hopefully DAC will be cheaper. So in 20 years' time, we'll use DAC likely to top up that 10%, cheaper than trying to capture 100%. But you should think of CO2 as like a milk bottle. The CO2 almost stays in the ship. It's the same ship. So think of LNG, ENG coming from Texas to Germany, offloading it into customers. They give us back the CO2 first via train, then via pipe. The CO2 is put on the same ship that otherwise would go back empty. So it's taking a free ride back. And what's really neat is that you transport LNG at minus 160 degrees Celsius, and you transport CO2 at minus 50. So actually, when you get to Germany with the liquid gas, and normally you need to consume energy to warm up the gas to put it into the pipe, we use a heat exchanger. So the warmer CO2 heats up the methane and gets liquefied at no cost. Then when the CO2 comes to Texas, we help the liquefaction process by passing the minus 50 CO2 in a heat exchanger, so to bring the LNG from whatever, 20, 30 degrees to minus 50. So you save energy on both ends, and the transport is basically free. So it's actually quite interesting. And where our secret sauce is to just over-engineer and use AI to get this entire chain as efficient as possible. But the costs are incredible. The cost is about 100 euros per megawatt hour today, going down this decade to around 40 euros a megawatt hour for delivered hydrogen into the factory.
Amazing. So we have another question over here.
Thank you. Hi. I have another mic, thanks. My question was more on the risk side of those non-conventional things, let's say. When we speak of the conventional, we know that one of the risks of a pipe in the ocean is that it could burst and flood. But now with ENG, how is the infrastructure and what are the risks associated? And we mentioned PPWS, and even if we do that, there are still risks associated. There's a nuclear power plant being built in the north of Egypt, or at least it's been announced, and they just put a barrier, which, as some of you will have noticed, it's quite sunny in Egypt. But it's also very close to Greece, where there's a lot of earthquakes. And one of the things people are discussing now is what happens if there's a big earthquake in Greece and we have a nuclear power plant in the north of Egypt, which is quite central in the world. So I'm just curious what your thoughts are on this, and then what the risks associated with ENG are. What can we do to prevent those?
So ENG is exactly like LNG. It's CH4. So it's a lot less risky, let's say, than oil from an environmental point of view. Of course, methane leakage is a real issue, but if you look at where the methane leakage is, it's mostly on the upstream. I've been running Europe's biggest midstream infrastructure, and we had very bad methane emissions, but they were 0.07%. They were still really bad, and we had a plan to get to zero. But if you look at the 1-2%, the really nasty emissions, they're all in the shale and in the upstream. So I would say that generally natural gas is safer than the other molecules from an environmental point of view, and also from a health and safety point of view, if there's an accident. Hydrogen is different. Hydrogen is smaller, leaks more, has potent warming effects. And the beauty of merging the carbon and the hydrogen together, it's a very natural compound. CH4 is a natural compound. It's what happens when a tree rots, or even just food. That's what happens. And so we're turning hydrogen, which is also very natural, but we don't find hydrogen on Earth, into something that's very, very natural. So I don't think I think it takes away risks compared to other stuff. I agree. I wouldn't build a solar plant in a sunny place for the reasons I said. I would put solar panels there. And solar panels don't have real issues with earthquakes. They're resilient, they're flexible, their frames can resist a lot of, and they're a sum of many tiny panels. So it's kind of it's a flexible system.
Wonderful. Unless there's any last questions here, I think we are going to head into the break. Is that right, Sonia? Yep. Brilliant. Thank you so much,
Thank
Marco.
you.
Please,
Thanks,
a round of applause for Marco. That was wonderful.
All right. We have our last break. So please take 10 minutes. We'll restart at 4:15. Please try to get back on time, because this last session is the one.
Here at COP27, do we need to be talking about nature? And we've got COP15 in Montreal in a couple of months' time.
I swear you just said I'd like to kick off Mark, which is a great starting point at this time of day. So my name is Mark Goff. I'm the Chief Executive at the Capitals Coalition. So we bring together all of those around the world that are looking at what is the value in the world, so the relative importance and worth. So we've got about 25,000 people we're engaging with at the moment that are valuing nature.
But to do that, you also need to value climate, you need to value society, you need to put that into the economic model, and it's about integrating those things. And we're here at Climate COP today, but I'm sure you've all seen the figures that nature is going to produce about somewhere between 35 and 40% of the solution for climate. So if it's 35 to 40% of the solution, how much do you think of the total investment that's going into climate solutions is going into nature at the moment? Any ideas? Yeah, it's just double that actually, it's 2%. But it's still only 2% is going into nature, and yet that's going to be 40% of the solution. So we've got that muddled up. And when we start looking at electrification of cars, we've got about 40% of the money at the moment going into that area, into electrification and technological solutions, and then, yet that's going to be a very minimal of a part of the actual overall achieving these targets. So these things are completely and utterly interconnected, and yet we've got the biodiversity COP coming up in 2 weeks' time in Montreal. So we're going to go from positive 20 degrees to minus 20 degrees in temperature for that one. But these things are interconnected. The whole idea of nature positive as an idea, have everyone heard that one idea? So you've got net positive, obviously, but nature positive, the idea that we need to, by 2030, actually have halt and reverse nature loss, which we know is happening at a great rate, but also, therefore, by 2030, be creating more nature than actually we are at the moment and we're taking out. Now, in the Intergovernmental Panel on Climate Change modeling, within that, they put nature into those models. And do you know what they put nature in? They put it in as a constant. So they put this in, that nature is going to stay constant over all of the modeling that they're doing, meaning that actually all of those models are going to be wrong. Now, we know models are always going to be wrong because of certain things, but nature is not going to be constant. We know it's decreasing. So we have to include nature in the conversation we're having about climate.
Thank you, Mark. That's an incredibly powerful intro for us. Robin, you work with companies, investors, banks all the time. Why is, actually this is the question that's just come in, why have organizations on the whole done less to quantify their nature risk and exposure compared to climate? How do you get them started? What are the obstacles?
So, I'm Robin Millington. I'm the CEO of Planet Tracker. Planet Tracker is a philanthropically funded financial think tank, and we're trying to value various aspects of nature. Why aren't investors or companies doing it? A lot of it is just a lack of understanding. It's hard to grasp what is nature. I mean, nature is everything. We're nature. Climate is nature. I mean, so what we're trying to do is look at supply chains and then take each supply chain and say, well, what is the important aspect of this supply chain? How do we start looking at the natural capital within the supply chain? In my traditional economics, things like raw materials were just assumed to be there. These days, we have to assume scarcity, depletion, or no raw material available at all because of the depletion going on. So you have to start looking at this differently and start valuing what have traditionally been externalities, to get into the jargon. But what we will look at, for example, is we're working on the seafood and fisheries. So we know that 60% of the fisheries are almost at capacity, 30% are fished out, so 90% of the fisheries are in steep decline. And yet, we took the Japanese fisheries supply chain, we looked at it from the fishing boats all the way through to the retailers, and what we saw was an amazing profitability with the actual resource of that supply chain in total decline. So how does that work? Well, there are a lot of cost-cutting aspects going on, there are a lot of mergers going on, but at a certain point you can only cut so many costs, you can only merge so many things. And there will be a moment when, as an investor, you're invested in one of these companies and there is no real value left. Or do we just keep fishing until the ocean is depleted and we have no seafood? Now, that's not an option, I think. So we're looking at also ways that we can address this financially through, say, blue bonds that will get the fishers to stop fishing for 5 years, pay them so that they will still earn a living, and yet replenish the fisheries so that we can move forward in a sustainable manner. So we have to be looking at this in a different way than we have in the past.
Thank you, Robin. Matt, we often hear that data, lack of data, is the biggest obstacle for companies and investors to get started. You want to introduce yourself and talk a little bit about the data challenges, but also the opportunities?
Sure, happy to. So my name's Matt Jones. I'm the head of nature economy at UNEP's World Conservation and Monitoring Centre. So we're the biodiversity specialist centre of the United Nations Environment Programme. The team that I'm part of is looking at achieving a net zero, nature positive and socially just future global economy that we all need. And part of what we do as an organisation relates very, very closely and heavily to data. And I've heard that a lot, and I'm going to call it nonsense. I think it's a complete misconception that there's a lack of data. There's a lack of understanding of what data's there. There's a lack of ability to use data. There's a lack of ability to access it. There's a lack of knowledge of how you go about that. There's lots and lots of lacks, but there is data, absence of data is not the chief problem when it comes to data, when it comes to biodiversity, when it comes to natural capital. And sort of when you take that a step further, it starts to build into, okay, what is wrong then? And one of the things that's wrong is we don't necessarily have the right infrastructure, the right connections. It's not feeding the data that's there, that I know exists. And we've got tons of stuff on hotspots of depletion of natural capital. We've got loads of information about species, about ecosystem integrity, but it's not feeding into financial decision making, partly because the connections, the pipelines don't exist. And we don't have the right collaborations and the infrastructure yet that we need to put in place so that this can feed into day-to-day financial decision making. And I think that's one of the big challenges that I see that we can tackle. We're not looking to suddenly be on the receiving end of thousands of data requests. And I say that as somebody who's on the receiving end of thousands of data requests. What we want to be able to do is to empower and enable existing data providers into the financial system, into the private sector, so that they can understand biodiversity data and they can feed it in so it's consistent and coherent and it's connected with climate data and it can be understood as part of the whole package. And to achieve that, we also need everybody to skill up. So we need everybody to understand that they need to be able to use this data, and in some way, shape or form, their job relates to nature in some way. Every business interacts with nature. I hear a lot of, oh, it's not material to us. That's also nonsense. Nature is a material risk to everybody because nature's crisis creates huge risk to business. And if you accept that and you understand that, then everybody's job is a nature job. Nature touches on every single person's job. You just need to understand how. So if you're in a procurement role, your job is a nature job, but you've got to understand how. You've got to understand how the data feeds into that. Same with HR, same with C-suite.
Nature is the base of every single supply chain, and I think that's a powerful thing for us to communicate and to remember. I feel we may have skewed the polling question, which is about to come up. Avril, I'm going to flick the switch. So what are the biggest challenges associated with organisations understanding nature and incorporating nature into their decision making? I can't see the poll right now, but it's over there. So do feel free to vote. Hopefully you've all got the QR code. What normally happens, before Matt did an incredibly good job of saying, actually, nature is
saying I shouldn't have called it nonsense.
Yeah. What normally happens is that everyone goes, data. Data is the biggest challenge. And now we know it's not. So, Robin, would you like to respond
I can't see it.
You can't see it either. Okay.
But I was just going to say, there is data. And it's become an obfuscation to say there isn't data or we don't know how to use it. It depends on what you're looking at, but there is data available, and if a little think tank like ours can take data and do the analyses that we're doing, large financial institutions certainly can do it.
Yeah, 100%. I'm going to pivot to a more controversial area potentially, which is putting a price on nature. So, Mark, can you talk to us briefly about putting a price on nature? Should we be doing that? Should we not be doing that?
This is something I think I've been accused of almost every day for the last 7 or 8 years, that basically I'm just pricing nature and I'm commercializing it and trying to sell it off. I think the thing is what we've got to do is pricing and costing nature is really key when you're making investment decisions, etc. But actually what we're really talking about here, and where we've got to start with this, is what is the value of nature. And value is something slightly broader, and it does include lots of other reasons. So if we're going to go and buy our coffee in the morning, we go and buy that because of the social norms, because of the other people that we know. We might buy it because of the label, the Rainforest Alliance label on there. We might buy it because of the cost, because this one's a bit cheaper than that one. There's lots of other reasons in there. That value that provides to us is very different than just the cost. I think that's just one example of these things. So for us, it's always about the value of something, the relative importance and worth, rather than just putting a price on it. What then happens is once you've valued it, when you've understood the context, and this is the problem we have, another thing coming back to data, if I say I've just used 1,000 tons of carbon, 1,000 cubic meters of water, in fact, through COVID, there was a front page of the New York Times was talking about a certain big company that delivers lots of goods to your house is going to save the world because it's creating thousands of new jobs. Someone asked the question a few weeks later, well, what sort of jobs were they? Were they good jobs? Were they bad jobs? And that's what value, or this pricing, costing does. It allows us to understand the context of this. Actually, what does it mean? Are they good jobs? If we're using water, are we taking it from an area where there is water? If we're planting trees, which trees are we planting? Are we planting the right ones? If we don't know that, then we're never going to be able to make the good decisions. So we need to have the value in there. Then for the investment bits, we need it in a common metric. That's when we start putting pricing and costing mechanisms in. But we do that when we have got a particular question we're trying to answer, such as an investment, etc., like that. Yeah. We don't start with the price.
That's fantastic. Robin, are you hearing about putting a price on nature in your work with corporates or with banks or investors? How do they incorporate or turn nature from something that can seem quite intangible into a business decision making? How does that work?
Well, I mean, you have to, again, it's, nature is everything and nothing, isn't it? I mean, you have to take the supply chain or the business that you're looking at and say, what are the important inputs into that business or into that supply chain before you really can start looking at how that's valued within the supply chain. It becomes material when you say, you need this, and the investor understands that you need this. So I'm not sure I'm answering your question, though. I don't think there's a one-size-fits-all.
Okay, so let's break that down then, and because I think that this is one of the biggest challenges. I think sometimes corporates, investors, banks, they think about nature and they think about pandas, and then they're like, how do I incorporate a panda into my decision-making? So how do we move from that thinking? I'm simplifying, obviously, but I think it's important to be pragmatic. How do we move from that kind of like, nature is not something that can be incorporated into practically exercises that do incorporate nature?
So about 80% of the case studies, and we've got hundreds of case studies on our database of businesses who are doing this, building it into their work. And they've come from WBCSD, the World Business Council, all the other people that are doing this. We sort of collect them all together and then look at them across. Most of them are around water use. Yep. So that's a really easy one. You can see water, we're all dependent upon it in some way, whether it's to run your office or whether it's to run your operations. If you've got operations in a certain area of the world, how you're dependent upon that water. Are you really understanding that water? Now, lots of companies, when you go into a new area, and I've done this myself, I worked in business for about 20 years before coming here, when we were setting up new data centers in America, the local authority would give us water for free because they wanted us to come in and create the jobs. We were going in and saying, actually, no, we want to pay for it, because if it's not on our books, how do we actually understand the value of that? So, and that sort of idea about connecting it in on a day-to-day basis, as Matt's right, there's a World Economic Forum report that's come out. In fact, I was tweeting about it late last night, I think it was about 1 or 2 o'clock, which you should never retweet at that time of day, can I just tell you that? But I was retweeting about it, and they'd said in this World Economic Forum report that 50% of GDP is dependent upon nature. That's complete rubbish. Everything is dependent upon nature. If you haven't got nature, you can't do the World Cup coming up, you can't do anything. We don't have people on the planet, we don't have economic systems. So there's always going to be a way to connect it in to what you're doing in your business. And there are tools and models. The Science-Based Targets Initiative, sorry, you wanted to jump back in? The Science-Based Targets Initiative on climate is now being made to the Science-Based Targets Network on nature. the TCFD, the Climate-Related Financial Disclosures, the Task Force on Nature-Related Financial Disclosures. All of these things are now being created. We pushed back at the beginning saying we don't want to copy those things, but actually we have copied them, and now we need to integrate them. There needs to be an integrated approach to this. So there's tools, the Natural Capital Protocol, which Rich was one of the authors of. That work actually gives you the way to assess what you're doing. You then go to commitments through the science-based targets, etc. You then go to transformations. You work with consultants to help you to do that. Then you go through to disclosure, which the task force and others like that can help you with. So quite simple, actually, when you start mapping this way.
If I can just bring this into a case study. We've been looking at the Gran Chaco, so we've been looking at deforestation in South America. So if you look at the microclimate of the deforestation will then take water away from a microclimate. That water then reduces the number of crops. So if in a normal water cycle you were able to grow 2 cycles of crops, that's twice the tax money to the Brazilian government. When you start having that microclimate, the deforestation, take away the double cropping, you reduce the tax to the government. So that becomes material, right?
That's a great example. It also reminds me that I need to ask Matt to explain the difference between nature and biodiversity. Because some people might be wondering, why are we calling it nature rather than biodiversity?
Do I have to?
Yes.
Honestly, I think to an extent I see the terms used interchangeably, and it doesn't offend me as much as it does offend some people.
Does offend me.
I know it does. Biodiversity is a very specific, technical, scientifically understood term. We're talking about the variety of all life. So we're talking about variety within ecosystems, between species, and within populations of species. So that's genetic diversity. So biodiversity has a really specific scientific definition. Nature is a broader concept. Nature incorporates things like water, it incorporates the way we interact with and live within a landscape, it absolutely incorporates people. So nature is that much more general, much broader way of thinking about things. Biodiversity has that really specific definition, which gives it, I think, a benefit of being arguably, it should be putting it on a pathway to being more measurable in certain ways, and we can be more clear about what we're talking about, because different people understand nature in different ways.
Can I just add, because...
It's jumping in a bit to chip in.
So WCMC actually did a great report on this, so your organisation for us, on this. A good way of looking at this is nature is all of those things, including us within it. Biodiversity, just building on what you were saying there, is the quality bit. So if you've got cotton, and you're growing cotton, we know that the quality of cotton is deteriorating again and again. The clothing that you're wearing, but in 10, 20 years' time, the cotton is going to be poorer quality because of the biodiversity. Water, the quality of water is increased by the biodiversity. So if you think about biodiversity as being that cross-cutting bit, which brings quality into those products, that's why we need it. If we have less biodiversity, the quality goes down from a production point of view, and at some point, it starts crashing the system. You don't have any more cotton. You don't have any clean water, etc. So the biodiversity is an important cross-cutting bit across that. I think that was a paraphrase of what you were saying.
Oh, that was wonderful, thank you. And it's also, I mean, it's specific and measurable, right? Yeah. So I have how many times have you heard someone say, oh, I'm going out and I'm enjoying nature? What they actually mean is I'm enjoying the outside, right? They don't really mean nature. It's not natural. They don't mean biodiversity. And I think that's the key way to think about the difference. They mean being outdoors. I look out there, I cannot see that I'm in biodiversity out there. I can definitely see that I'd be in the outdoors, and I'd quite like to be right now because the sun is setting. And I can probably look and I can probably understand a concept of nature out there somewhere if I look a little bit further than the swimming pool outside the hotel. But I mean, that's, I think, a way to really start to think about and see the difference between those things.
But I think this leads to a larger issue, if I could offer. I think that these terminologies, biodiversity is an old terminology. It came really out of the whole thing about species decline, right? So we're talking at first about species, even though it's maybe morphed into what Mark has been mentioning about the quality. But we have an issue across everything that we're doing right now, because the metrics that we use, GDP, what do we measure with GDP? We measure growth. But we're not measuring decline or scarcity with that. It's, as long as things are growing, we're very happy about it. GDP was created at a time when we were in a Great Depression and going into a world war, so growth was absolutely important. Bretton Woods then enshrined it in 1945. There was a whole other school of thought that was all about not growth, but quality of life. And they didn't win, growth won. So we have this whole issue of how do we frame what we're talking about, whether it's biodiversity in nature, whether it's growth versus quality of life, whether it's, you know, whatever we're talking about right now. We have a whole moment where we need to think about a reset of how we're framing everything.
And we have to do it very quickly as well, because if there's a natural disaster, so the fires in California, GDP goes up. So we want more fires, is that right? So we want more natural disasters, because then GDP goes up, because you put more money into the system. Now that is completely perverse, because we're not taking account of natural capital in GDP, and they're reviewing GDP at the moment, and several of our team are actually writing a chapter for the first time in the GDP review about that idea that actually we need to incorporate it. There's no way it's going to change straight away. GDP is a useful measure for certain things, but we've got to be aware of the limitations of it as well.
Thank you, Mark. Matt, coming back to the data issue, you said it's nonsense. There's no data. That's. I was going to think of the word, but there is data. Can you explain a little bit about the types of data that are available, like for our audience here?
I mean, I can, but I'll be here all week.
Okay.
I mean, that's what I mean. There's a huge amount out there, and that's why. I mean, I'm sorry. I used to answer that question quite politely, but I've been being asked that question for about 5 years, and it's got to the point now where I just want to really challenge that.
Yeah.
That there is no data. It really is nonsense. It's an excuse.
Yeah.
We have absolutely tons of data about species. So we know a huge amount about where species are. We know a huge amount about what's going on within their life cycles. We know a huge amount about what is threatening them, how close to extinction they are. It is not perfect. Of course it's not. And there's a long way to go. It's not, for example, representative of everything. So we have all the data we really need right now about mammals and birds. We have very, very little about plants. So, you know, it's taxonomically, as in the breakdown of different types of species, it's not representative. So that's a flaw with it, but we can work through that and we can use models to address it, and there's ways to work around that. So we have a lot of information there. The other component of biodiversity I talked about was ecosystems. Okay? We have a lot of information here as well. We have loads of information about ecosystem integrity. So we can understand how connected ecosystems are, how close to an original state they are. So we have loads of information about what's going on the ground, and we can look at the state of nature. What state it's in? It's in a good state or in a poor state. Most of it's in a poor state. And we can also look at some trends, and we can start to see those areas that are perhaps under threat. We've got a lot of information about natural capital assets, so the sorts of things that we rely on that provide products and services that are depended on by society, that are depended on by business. We've got information about where those are and how those connections are made. And again, we can see some things about the quality of those, we can see some things about trends over time. And we can also see areas where we know they're being depleted. And where we know they're being depleted, that means we can start to look at a connection with risk. Because if we're in an area where we all accept, and I'm going to defend WEF actually, they were the ones that wrote the original report that everyone's misquoting. So everyone says, the WEF says 50% of GDP is dependent on nature. They don't. They say 50% of GDP is generated in economic sectors which are highly or moderately dependent on nature. That doesn't fit on a PowerPoint slide as well. So everyone's getting it wrong, and they're missing this vital point. Everything depends on nature. Absolutely everything depends on nature. So we can see, if you're highly dependent and you're in a hot spot of natural capital depletion, you've got a real problem. If you're investing in a business in one of those places, you've really got a real problem. So we can start to look at all that as well.
If I can get back to this issue of how do we deal with the metrics around nature, one of the things I find very difficult is people come to me often and say, well, we have 1.5 degrees and we have emissions and climate, and it's easy to understand, right? But if you start deconstructing it, instead of looking at this huge thing and its nature and its hundreds of metrics, if you look at fisheries, there is a simple metric we can use there. It's called maximum sustainable yield for the fishery. We know how many fish can be fished until it goes into decline because they can't reproduce. You can start picking this off bit by bit by bit, supply chain by supply chain, and find those key metrics. But there is no one size fits all like a 1.5 degrees that we find in the climate space. But it doesn't mean that there isn't that metric on a supply chain by supply chain basis.
Thank you, Robin. I'd like to invite any questions from the floor. You can just submit them, or you can also go old school and put your hand up, and I'd be happy to take questions. Do we have? Yes, Sonia.
There's so much data to analyze to assess biodiversity and nature risk. What are you hearing from stakeholders around which realms are, the higher priority? I mean, could you give us some, maybe not some data, but just some anecdotes and trends?
So one of the challenges I have with these tick box sort of GRI indexes, and remember I worked in corporates for many years and head of strategy, so I've filled in loads of those forms, is that what they do is they tell you that certain things are important without actually understanding the impact and dependency. So materiality should be based around your personal impact and dependency. So if you've never done that assessment as an organization, you can't just go down to a list and say, well, water will be important for me. Well, why? Whereabouts? What do you need to know? So you need to do the impact and dependency before you can have a list of indicators. And everyone that keeps on giving me these lists, I keep on thinking, well, where's the impact? Where's the dependency in that? You need to know that, first of all, before you can get into any sort of conversation on that.
Yeah, I would agree with that. I think the thing that I'm really seeing demanded right at this moment is people to understand their dependencies in particular. We've understood high impact sectors, and it's one of the reasons why, if you look at mining and oil and gas, they look like they're really good on biodiversity because they've been hammered and hammered and hammered over it for decades, so they've really upped their game. All those people who are really dependent on biodiversity haven't had that same level of scrutiny, and so they're not there, they're not in the same place. And also, people aren't really getting that, and they haven't got that experience and the longevity around working with it that they need to be able to do it. So I think understanding dependency, that's the key thing that I'm hearing and seeing right now as one of the most important. And anything that's just looking at impact, yes, absolutely, we need to reduce pressure on biodiversity. And please don't walk out of this room and say that guy from wherever, he said we don't need to worry about that part. Categorically not what I'm saying. But what I'm saying from a risk perspective, particularly when we're talking about nature-related risk, if you don't understand your dependencies, you're nowhere.
So we looked through all of the ESG, we just looked through all of the ESG different indexes recently. We just released a report a couple of weeks ago on Beyond ESG. Not one of them, apart from the WEF actually extended criteria, included impact and dependency. So even the International Sustainability Standards Board is saying maybe 5 years they'll get to that. They're looking at the metrics first. This idea behind us, you can't fix what you can't measure, I disagree with that as well. Measurement is just a number. We've got to get to understanding what that measurement means. And if we don't start looking at the impact, though all of these indexes are not going to make any difference there.
Yeah, so I was interested in the sort of positive investment story because at the Sustainable Markets Initiative, we kind of wrestled with this problem, recognizing that there's not much capital going into nature. I don't want to put it in inverted commas, but natural capital solutions to the problems or anything else, apart from a few niche businesses that have a kind of dinner party story approach to the whole thing of market. It's tiny. It's a bit hard to put your finger on how that 2% could get bigger when you don't actually know what you're going to invest in that would have a revenue stream or an income stream or anything else. Apart from maybe the obvious super illiquid things like forestry, farming, etc. So I guess the question for the panel, particularly on marine, given that no one owns the ocean, but if they did and they own the fish, it would be a game changer in terms of preservation. Like, what is the way that one would be investing? Because it's really obvious to me what we might think about from a risk and what do we stop doing, but that's not really your point. I think your point was money needs to be deployed.
Yeah. So on marine, I agree with you fully. The problem is the lack of ownership of the asset, right, of the main raw material that's the input. But the thing is, want to believe that a company would have its own self-interest in heart by taking care of its asset, but they're not, because what they do is they fish out one fishery and they move on to the next, and they're not staying around to worry about whether it's replenishing itself or not. And this is why the concept of these blue bonds that we're working with to try and pay the fishers to just stop fishing for 5 years is a longer-term view. Bonds are a longer-term view. It's a longer-term investment cycle. And that's what we need to do for much of nature, is look at a longer-term cycle. The short-termism of too many of the equity investments just doesn't help us replenish or to keep the nature secure.
I guess I take issue with that kind of commonly held view equity markets are super short-term and people really think about next quarter, because that really doesn't stand up to scrutiny. I mean, investors are investing in wildly unprofitable businesses. I mean, think about Uber, had great revenue, yet again, $1.2 billion loss in the last quarter. I mean, people make bets on very long horizon issues in equity markets. And I think they can do it in this area, provided that kind of, the value proposition is strong.
I do agree with that. I think one of the things I found in the last several months, actually, we've been approached by an awful lot more organizations setting up biodiversity credits and things. So there is a plethora of people. I don't think Simon Zanek's here, is he? I saw his name on the list. But he and I have been talking about that. But the climate markets, when we started doing that work, there was a sort of an agreement we would let the markets play. I think with the biodiversity credits, what we're trying to do is make sure we're clear on what an asset is, first of all. We're trying to bring some bottom-up governance. We're not talking about top-down regulation. But if we can bring that in at the beginning, then we start developing that trust that will start bringing that money in. So we are seeing in corporates that are starting to use our works, OLAM particularly, they're getting a lower cost of capital now, financial capital, from DBS Bank and BNP Paribas and others, because they're able to understand this dependency and the risks and the impacts they've got. So they're actually drawing more money out of the markets because of that. It's different because there's greening finance and there's financing green. They're two separate pieces there. But I think the biodiversity credits market is I'm quite hopeful that it's growing very quickly and that we can do that in a stronger way with more trust in the system than we did with climate, which we know has been on a roller coaster ride to get to where we are now.
Thank you. Matt, maybe you can expand on what Mark was talking about biodiversity credits and markets. So biodiversity is something that often comes up in a lot of our presentations, and it's contentious. So it'd be good to get for you to help us to understand what it means and where the areas of contention are.
I mean, so what we're talking about here is in similar to climate. We're talking about somebody being able to say, well, I hate saying it like this because it's wrong, but I've created some biodiversity and therefore I want to now be able to turn that into something that is tradable, into a credit that I can trade. And largely that might be used in a market to somebody who's got a hard-to-abate sector somewhere who actually wants to say, well, I want to achieve my no net loss commitment and I'm going to do that through a traded credit. I think there is some opportunity here. There's opportunity in particular because we have, for better or worse, seen an interest in tradable markets, both for climate and for biodiversity credits. There's an opportunity to bring those two things together and to make sure we're thinking about multiple benefits. We can't just think about those two benefits. If we're not including social justice in that, then we are dooming it to failure. And I think that is one of the biggest risks around biodiversity credit. I don't share your enthusiasm, I don't think, Mark, for it being in a growth phase, because I think it is one of the biggest potentials for effectively a near-colonial land grab that we've got right now, if done badly. So yes, I think it's something that warrants further looking at. We need to think about it more, and there has to be some investment in that, and that's going to only happen if it does look like it's going to go somewhere, and it is accelerating. But if we do not incorporate that social component, if we do not incorporate social justice, if we don't understand whose land we are talking about, who occupies that land and what do they want with it, then I think it is absolutely doomed to failure.
I do agree with you. I think you're just half cup empty and I'm half cup full on that. And that's exactly why at the end of this year in Davos we're going to be launching the integrated protocol. So we're now the Capitals Coalition. We were the Natural Capital Coalition. We realised we were as much of a problem just being the Natural Capital Coalition as we were when we were just looking at the financial economics. Because actually just looking at nature has unintended consequences that you're not taking account of. So we brought together the social, the human, the produced capital all into one network, and we're coming out with the protocol around that, which will look at those trade-offs, we'll look at that allocation, we'll look at how you must be able to address those mixtures of things that are going on there, and that is going to be really key. And it could go very wrong, but I am hopeful we're going to get a bit more than what you think.
Well, I'm normally a very positive, optimistic and cheerful person, as you know, and we're getting to the end of the day, so I'm even more positive and optimistic.
Drinks are coming, it's okay.
But I suppose what I'm seeing at the moment is I'm seeing a real trend, particularly among oil and gas companies that are recreating themselves as energy companies. And among those companies, not just looking at the potential for carbon credits and biodiversity credits as a way to get themselves to net zero or to no net loss of biodiversity, but actually as a future big part of their business. And I think that does open up some serious concerns, particularly among indigenous peoples and local communities, about decisions that are going to be taken about their land that they occupy, and how they're going to be involved in that process. The degree to which we already know free, prior and informed consent of local communities and indigenous peoples is not universally followed. So I think there are some big concerns with history, patterns that we've seen in the past of behaviours by large footprint business in their normal operations, in their historic operations. I think there's probably a few concerns about where that might go in the future. And trust is a word you use, Mark.
Yeah.
And I think it is probably the most important word in this particular conversation.
But the thing is, it's going to happen. We're not going to stop. I was talking to a big landowner yesterday who is starting to set out models where they will not have to charge rent, okay? Because the quality of the land that they've got, they will be able to take the credits from it and won't be charging rent in the same way as they are now to the people that are leasing the land from them. Because the land has value in it, and if they can take that out in the asset and separating the asset from the flow of money, then they can make that work. Now, I'm not saying, but it's going to happen, so either we can sit here and complain about it, or we can all get up after we've had a drink and go and deal with it. Okay.
Robin, are you a glass half full or glass half empty?
I'm in neutral.
Do we have, Susan, question.
Just picking up on and also your comment that there is one logical KPI for one logical measure to use for each of these sectors. Just picking up on the financing point and the point earlier about one logical measure to use for each of these subcategories, if you like. I mean, have you explored the opportunities around sustainability linked and looking at what sort of KPIs would be ambitious and material for each of these areas, and trying to, because I think that's part of this, right? If you're a fishing company and you're doing a sustainably linked financing, what sort of KPI should you be thinking about?
I think it's more obvious in some of the supply chains we work on than others, but in fisheries that's an obvious, isn't it? No fisheries without fish. No fish fingers without fish.
Yeah, I suppose my question is, as a sector or as a group, are you thinking about these sort of things in order to try and, back to Lauren's point, how do we connect the dots?
Yeah.
How do we get the point across to the community and to business, and how do we get to a point where we're creating the linkages that people naturally say, okay, this is what we need to do here. This is, or they're at least indicia of progress. So,
I'm not quite sure how to answer that question. What we're doing is case studies, and we're looking at particular supply chains and industries. And I think you have to start building from we build from the bottom up, and we're just trying to understand, and that will build out. I think you begin to see the linkages as you build up and build out, rather than trying to set it all up. My biggest worry right now is that we're letting perfection be the enemy of progress. We're trying to set up all these metrics up here, whereas we can just get on with it. And I think a lot of the analytics are available now, but you just have to sit down and really take time. I mean, when people are under time stress, this doesn't come easily. It's not well packaged. It's not automatically available. And that's part of why people aren't just getting on with it, because they want to get a report out in a couple of days, and maybe it'll take a couple of weeks or a couple of months to finally bottom out in this industry. Well, what are the linkages that we should be thinking about? Where are the dependencies? What are the KPIs?
Most of the so we've done sector guides for different sectors, and most of the time, so we're just doing one at the moment for the pork board in the USA and helping them to think through it. And actually, when you bring them together as a sector, there's lots of commonality in there, and it does shortcut, and a lot of your work's really helpful with this, it does shortcut some of those questions to get us to where we need to be to. But what the fundamental question, building on what Robin was saying, is actually, do you want better information? At the moment, you've got poor information to make your decisions. Most of the decisions you're making, most of the decisions I was making in business were actually based only on financial numbers and not including anything else. If I'm making those decisions and I can get better information, I'm not saying perfect, but better information, that will help. So working as a sector definitely helps, working across different systems, but the value chain work. And can I just bring in now the make it mandatory bit, or is that you going to bring it in later? Okay.
We're about to wrap up, so now's
Okay,
perfect
now's
time.
quickly. So we're going from COP27 to COP15 in Montreal, okay? So we're going from the climate COP to the biodiversity COP. Everyone knows there should be one thing, they're not. We're not going to have as many heads of state at the biodiversity COP. We're not going to have as many people there. Maybe there'll be a couple of thousand, not the 50,000 someone was telling me here. That can't be right. 30, okay, good. Someone was, yeah, anyway. So the biodiversity COP, in there's a target 15, which you probably haven't heard of. There's a target 18 on subsidies, so subsidy reform, $1.8 trillion worth of subsidies that are going against nature, that are basically destroying nature. So no matter what we talk about up here, it makes no difference. That $1.8 trillion is what's going to drive the markets, okay? So we've got to change those subsidies. You talk to governments and you say, you've got $1.8 trillion that's going in the wrong direction. Their first question is can we have that back, please? And we're saying, no, redefine that, put it into some other things that are positive. But that's a really big debate, target 18. Target 15 is to mandatory assessment and disclosure of impacts and dependencies. So it's what we're talking about here becoming mandatory. Why would businesses ask for that? We've got 330 businesses that signed a statement last week asking for that. Lots of assets under management, etc., and others in that really big companies. We then opened up our delegation, and Matt keeps on joking to me about this. We opened up our delegation to say, because I think the Paris moment happened because business really started engaging. So we're going to take business to Montreal. We were told maybe bring 30 businesses. We opened up our delegation, us and a few other partners. We had 700 apply. I had another 200 in the last couple of days. I've only got 25 staff, so that's going to be quite difficult to take a delegation that big, and we have got partners that are helping us. But we are going to take business en masse into those conversations to make this mandatory. And those are in the brackets at the moment, but if we get that to make it mandatory, then what we're talking all about here takes a massive step forward. Okay, maybe it's large companies, maybe it's small companies, whatever, that will all be debated. But that will really change what we're talking about.
Thank you, Mark. What an incredible way to wrap up. Very inspiring indeed. So thank you so much to my panel. And I'll pass back to Sonia.
All right. What a day we've had. We've got one last agenda session, and this is exciting. We've got Richard coming back on stage. He will be leading a discussion with the chairman of the Egyptian Stock Exchange to talk about designing a sustainable investment marketplace.
Wonderful. So, without prejudice to all the previous, I do feel like we saved something special for last year. We have Rami El-Dokani, who is Executive Chairman of the Egyptian Stock Exchange with us. And we have a short period before drinks, so don't worry, please don't leave. But we have a very exciting conversation to have right now. So Rami, I'm really excited about what you launched. You launched something quite incredible yesterday, which will have huge benefit for Africa, for this region. Love to hear more about it. So let's start with that.
Perfect. So good evening. We'll try to make it quick, fun, and because everyone wants to have a drink, so let's do that. So we launched yesterday the Africa carbon credit market. So we're launching the first carbon credit trading platform in Africa, hopefully to be live by Q2 of next year. We've taken all the steps required, and we're going to approach the regulator, and the regulator also is doing the required regulations to recognize carbon credits as a tradable financial instrument here in Egypt, and we're going to open it also to all our neighbor countries in Africa to trade.
Round of applause.
Thank you. If you have money, come and trade with us.
Okay, we can probably finish there.
There's a basket gonna go around now. So.
No, I think this is amazing. Why? Well, just another question. I mean, why have all exchanges not done this so far?
It's a very virgin area for everyone, and not everyone understands the potential of it, especially here in Africa. We started recognizing, and I just got onboarded on EGX 2 months back, but the fabulous team of EGX has done a fantastic work about it. And the current regulator was the previous chairman of EGX, and he done also a great work about that. We try to always create value in different leagues and in different ways. Carbon credits has been there for a long while, and it's been trading privately for a long time, but we just triggered the idea that it requires better transparency, and it requires better liquidity, and requires better disclosures. Thus, having an actual exchange is key for African credits to be traded at a decent pricing versus global ones. Currently, with the current model, there's a problem that African credits sell at a steep discount versus global credits. We're talking about like African credits could sell at $3, $4 versus $10, $9, $18, $20, sometimes $100. So there is a steep discount for African credits due to lack of transparency, lack of knowledge. Everyone is taking them for a ride. So there should be an actual thing. The second thing that we have to come together, all of us. We're scattered. We're over 50 countries in the continent. We need to come together. We need to come on one side of the table. We should start putting our supply side as a unified front in order to be effective when it comes to pricing. So that was the ambition that drove the entire discussion.
And just another question. I mean, what type of credits do you see? You know, what's the proportion of different types of credits you're going to expect coming through the exchange?
Okay, so we're expecting we also invested into a development arm to help local projects start issuing their credits. And through that arm, we're expecting in the coming 3 to 5 years around 7 million tons of credit to be issued and hopefully traded. The problem and the main bottleneck when it comes to carbon credits is the verification and validation process. And with the current model, it could take up to 18 to 24 months actually to turn an actual certificate into a tradable instrument with the stamp of quality actually to be traded. And it cannot scale with the current model. It can never scale. With all the respect, with all the love to all the verifiers and validators in the market, they cannot scale. It has to be disrupted, and I'm always saying that it has to be disrupted. We have to get innovative models in it. We have to have more agencies for that. We need to get the cost of verification and validation down in order to have a proper business model for everyone. But this is the entire story. Yeah.
So, just more broadly, thinking about the role that exchanges have to play in capital markets, and it's critical, you know, the connectivity in capital markets would not be achieved without exchanges. How do you think actually exchanges should really be thinking about climate risks and opportunities to get those types of risks more priced into capital markets?
Okay, let's look at the opportunities first. I always love to start with the opportunities. When it comes to sustainable products, the opportunities are endless. Every now is, if you don't talk about sustainability, you're going to be crucified at one point or time. Right? So you have to go green, you have to talk about sustainability, and we need to make it happen. So labeling certain products to investors, saying that this is an ESG index. I was just talking with my friend there that we need to be highlighted with ESG indices in the products, because the demand on ESG funds has been tremendously big in the last 2-3 years, and the lack of actual products in the market, it's killer, especially in this part of the world. But this is one area. The second area is the availability of data. So with our hosts, with S&P and others, data is key, and it's always a problem for all investors that companies do not disclose, we don't have the availability of data, we don't understand what they're doing, all the entire story behind data. So this is also a potential opportunity for businesses to come and to help listed corporates in order to actually grab the value of their data. The threats that we are seeing from that, things like greenwashing, for example, this is something that would require regulatory action from their side. It is key to prevent greenwashing. And also in another discussion, I was talking with the regulator, we don't want carbon credits to become another Bitcoin. That it's everywhere, it's unregulated, and everyone can issue credits at whatever price, and you see different platforms. So it shouldn't be another myth that no one controls or no one understands the fundamentals behind it. Because I told them, no, carbon is a fundamental, there is fundamentals behind it. Yes, you do not see it, but there is a fundamental asset behind it. These are the two risks that I'm thinking of.
And do you think actually, let's talk about transparency for a second. Do you think there should be, some kind of transparency, mandated transparency regime that maybe you could help enforce, or is that more of a regulatory issue?
I don't enforce. I try to lobby with the regulator. Let's be politically correct when we talk about the regulator. But no, definitely we do not enforce, but we definitely lobby and liaise with the regulator on many things. And the regulations is important when it comes to that. ESG disclosures in Egypt are already mandatory. We're going to see these disclosures coming in online by end of Q1 or Q2 of next year. I'm expecting that we're going to see a mess in disclosures. And one of the major roles of EGX and other exchanges actually is capacity building and training the IR officers to actually disclose and what to disclose. Because when you come to ESG, it's not only a financial information or a simple disclosure that you actually have to communicate. It gets into different aspects of the business. You have to go to the operations, to the procurement, to the finance guy. You have to go into the entire company to understand and to report properly on your ESG performance. But definitely disclosures is key. The demand from investors to understand more about the business and to disclose better will push corporates by the time to get better disclosures in place. Definitely I'm saying no, we're going to see a mess in the first run of disclosures, and this is good, this is healthy. Everyone has to learn, everyone has to be directed. We're going to understand who's good, who's bad, who actually understands what we're doing or needs to have a further educational program or a special capacity building program in place. So we're working on that.
Great. And what is the importance of collaboration between exchanges?
Collaboration is key. We always say that markets are global, right? Regulations could be local and everyone regulates the way, but at the end of the day, markets are global. You cannot prevent markets to interact and this. So collaboration is always there. The key for example, for carbon credits, we were talking with our friends in another country on their exchange that we need to avail liquidity between our exchanges. So we need to connect commercially between each other. Let's not go into the complications of equities where you have to do a list and all that area. So let's keep it simple. Let's try to create a simple model for credits to trade between different platforms and different exchanges. This would ease up the ideas. The second part is important in collaboration. For example, many exchanges are members of different federations. You have the WFE, the World Federation of Exchanges. You have regional exchanges. You have the Arab one in the region. You have the European one. You have the Eurasian ones, the African ones. It is important collaboration for many things. First of all, is positioning. You need to always understand where do you stand versus your peers. What are similarities? What do you need to know more? it's always healthy to understand how do they price, what kind of disclosures, how can we cooperate on different ideas. You'll find a lot of technicalities in the normal day-to-day business of exchanges that are quite similar between everyone, yet we do not have like a standardized or a synchronized manual to do it. So I think this is the importance of collaboration in this regard.
So yeah, collaboration to scale from a global markets perspective is
very true.
Yeah.
And to put pressure on vendors.
Yeah.
This is very important as well. They're taking us for a ride, everyone on his own.
So any questions from the audience? There's one over here.
Hi, I was just wondering what the expectation is around focus and sort of standardized contracts, and what the concern is potentially about driving. Like, standardization around contracts is very important for scalability, but it has the potential to strip a lot of the independent attributes of voluntary carbon credit projects that make them work. So I'm just kind of curious as to sort of what the plans are around that, and yeah, just talk it through, I guess.
Yeah, I definitely agree with you. Standardization is important in that area. But the problem that you have different types of sectors, and each thing has to price differently. And because it's still super unorganized and it's still superversion, and everyone does not know how to handle it. And even on a global manner, we're not talking about Africa or the region as well, but if you see experiences in North America or in Asia, you'll see the similar, that it's, I don't want to say chaotic, but it's so unorganized, let's put it this way. So standards contracts are there, but I'll definitely see it's going to change by time, by better learning and bringing in more financial institutions on board to provide different layers of financing for these credits, having different performance ideas for the developers of the credits with the projects, and how can you finance these projects in order to develop the credits. So you're going to find many stakeholders developing while the process goes on in the entire value chain. So contracts will definitely start developing day by day. But if you are talking about the similarity between contracts and or the synchronizing regulations to allow the similar certificates or contracts to trade on different platforms, I think this is one area that we need to work on quickly. And this is also was one idea announced by the regulator yesterday, that we need, among Africans, we need to synchronize the regulations in this part in order to allow credits from different jurisdictions to trade in different platforms. I hope I answered that.
We can, yeah, it's it's more that it's sort of an interesting, it's kind of a question that's been going on around the carbon markets as well, as sort of the variety of different pricing mechanisms that are out there. And so I just, we do a lot of the pricing side on the commodity insights and around sort of trying to make sense of that very chaotic thing. And I think that fundamentally at the center of it is sort of a mix up between whether or not they are financial instruments or commodity instruments, because they sort of straddle that line in a way. And I wonder if there's a role for both within sort of an exchange-based space, either through auctions or through sort of direct trading. Anyway, I'm very interested about it, so I'd love to talk about it
super.
more.
And I'm going to tell you, in Egypt, for example, we are going to consider it as Europe is doing. It's a financial instrument, because for a reason that in developing countries, derivatives or commodities are still not as developed. So we don't want to stick to an undeveloped regulatory thing, so we prefer to do it as a financial instrument. This is going to ease up the story. But again, you're going to find different models in different places of the world due to that.
Sure, you could continue that conversation over
Yeah, I don't want to monopolize the question section, sorry.
Any other questions? I realize we're close. One here.
It's great to hear about the regulation. I'm wondering, are there going to be any initiatives then to also be tracking if the regulation is good? There's a bit of a lack of sustainable financial literacy, let's say, in the country and in the continent. And this is obviously where our role steps in. But one thing that we've seen in Europe, for example, is because it's not necessarily legal or not required for it to be audited, that a lot of times we see things that just don't make sense in terms of disclosure. Is there also part of the regulation something that's going to state that this needs to be verified or tracked or audited so that we can ensure is the disclosure legit, basically?
Okay, so baby steps first. Let's take it baby steps. The first step is to put mandatory disclosures in place, and just let's do the first run and see how messy is going to be and how we need to educate people. Actually, my colleague sitting behind you directly is responsible for financial literacy, so you can have a long, fantastic talk with them. But definitely there is a learning curve that it has to go through, because I totally agree with you that we're going to see unrealistic disclosures in many angles. And because they always link ESG with CSR, they don't actually understand what is ESG for or what sustainability stands for. So it's a learning curve. It cannot happen day by day. But I always say that the best way to make them or to force them to understand is to advocate that sustainability is an actual commercial part. It's an actual commercial business. Once they start understanding it is commercial, it's no longer a nice to have thing or just to look fancy and green and we're all drinking from paper cups, they will do an actual work. So it's a long learning curve. We have to start, but yeah, we're still infant in this phase. But I would like to tell you, we are well advanced among our peers in the region when it comes to the ESG profile. I mean, we were the first signatories on the SSE, for example, and big supporters for them, versus other countries in the region, richer and maybe well advanced on technology, they're not doing the same steps on ESG.
Any more questions?
You're waiting for the drinks?
Probably. Well, look, can I just thank you so much, Rami? That was amazing. I think you're doing, you talked about baby steps. I think you took a giant leap, to be honest, in that voluntary carbon market. So congratulations. And it's been a
Thank you,
pleasure.
sir. Thank you.
Thank you so much for joining us today. It's been fascinating conversation we've had. I thought I'd just quickly wrap up before drinks by saying, yes, drinks, and more drinks. This is also my second COP, and I have to say that I know that this year's theme is around action, implementation. And I think what we've heard today is that despite some of the, some of the naysayers around the progress we're making, we are mobilizing, we are innovating. We saw and heard from people who are innovating around intelligence, data solutions. How do we get more granular? We heard from Marco on some of the advancements in technologies in the energy space with electrified natural gas, ENG. And then we also heard from, we've heard from our chairman here, who's managed to set up first carbon exchange in Africa, which is amazing. I mean, if those aren't examples of working together in partnership and innovating towards a more sustainable future, then I don't know what is. Thank you so much to all of our guests and our panelists. Thank you. And please join us for a networking reception right out here. Thanks.